So just a couple words of introduction before we get started. I'm Lisa Donner, and I'm the Executive Director of Americans for Financial Reform. I want to thank you all very much for joining us. AFR is a coalition that was put together in the aftermath of the financial crisis to make sure that there would be a public interest voice fighting to change the financial system. Our coalition includes more than 200 organizations, including civil rights groups, consumer advocates, labor, community-based organizations, seniors, business groups, and individual experts. Together, we campaigned to make Dodd-Frank stronger and to get it passed. We've pushed to see it implemented effectively and worked to keep it from getting repealed, and also kept pointing to the other further steps we think need to be taken to get closer to our core goals: a financial system that's less dangerous to ordinary Americans' economic well-being and that does a better job enabling a fair, productive, and sustainable economy. So we're very, very glad to have our speakers and panelists and all of you together today to talk about where things stand 5 years later. Dodd-Frank was passed in response to a devastating crisis that is costing tens of trillions of dollars in lost output, left many millions of people unemployed, led to foreclosures at rates not seen since the Great Depression, cost millions of families their homes, contributed to growing inequality, and multiplied an already terrible racial wealth gap. The crisis made it incredibly obvious that financial questions that used to seem obscure, in fact, matter to all of us, and that how the banking system is designed is not something that we can safely leave up to the unilateral decision-making of bankers and captured regulators. It's worth noting that even 7 years after the height of the crisis, public opinion on this point has remained very steady. We just did a little polling that shows that large majorities across lines of party and region and anything else you can think of agree that banks need more, not less regulation. Dodd-Frank was the most dramatic regulatory change since the New Deal, and also really the first re-regulation of the financial system after decades of relentless deregulation, broken perhaps only by the passage of the Card Act. But despite the terrible clarity of the need for change, Dodd-Frank was also very clearly a partial approach, in most ways strengthening the hands of regulators, but not requiring dramatic structural alterations. And in leaving so much to the regulators, it also moved many important decisions to a playing field where it can be even harder for public interest voices to be heard, and where matters can easily disappear into seemingly technical decisions that dissipate the force of statutory requirements. At the same time, though, those directions to regulators, in fact, include some potentially very powerful levers when and if they have the will to use them. So with some pieces of Dodd-Frank up and running, the CFPB, for example, or also the FSOC and the OFR, new institutions, some rules already in effect, others written but not implemented, and others still unwritten, where does the financial system now stand? To what extent is it safer? To what extent are consumers and investors and taxpayers better protected? And to what extent are we better served? And what needs to happen next if the passage of Dodd-Frank is going to be a first step, not an only one, towards a financial system that, in Pope Francis's words, serves rather than ruling? So we'll open this afternoon with a keynote address from Senator Brown. There'll be a panel of regulators, a panel of experts, and then Senator Warren will close. It is a most terrific honor to have Senator Brown, the ranking member of the Senate Banking Committee, join us today. His leadership has been absolutely central to forward movement on financial reform, to passing and making Dodd-Frank stronger, including taking on some very tough battles like fighting for regulation of auto lending, to insisting on accountability from financial regulators, to pushing the conversation ahead past Dodd-Frank to clear structural changes and bright-line rules in crucial areas like increased capital or shrinking and limiting the size of the biggest banks, like that important amendment he introduced with Senator Kaufman. And also to the hard, critical, effective, and often unsung work that the senator and his staff along with him do in defending financial regulation from what are really relentless industry efforts to roll it back. I'll just add, before turning over the podium, that it's particularly striking to me, and I expect important to how the senator accomplishes so much of this, how clear and focused Senator Brown is about the connections, the deep connections between financial regulation, or the lack thereof, and the economic lives of ordinary Americans. So thank you, Senator. Thanks.
Lisa, thank you. It's an honor to be here, a pleasure to be here, and thank you for the work that you do and Americans for Financial Reform do. This is my real voice. I'm not sick. I don't smoke. I just talk this way, so used to it. My wife, this is a true story. My wife and I were at an event in a room about this big, but no tables and chairs, so everybody was kind of packed together, standing there, and there were a couple speakers, and as I took the platform, took the microphone. I start talking, and this guy turns to my wife. She'd never seen him before and said, "I hate that guy's voice." She said, "Really?" He said, "Yeah, when that guy speaks, man, it's like fingernails on a blackboard. I can't stand listening to him." My wife said, "I like his voice." She said, "You like that guy's voice?" And she said, "Yeah, you know when I really like it?" And he said, "When?" And she goes like this and leans in. He leans and says, "I really like it when he wakes me up in the middle of the night and says, 'I love you, baby.'" So that guy disappeared so fast. And speaking of my wife, I walked in the room. I was walking down the hall today. I run into a young man named Cameron McCain from Columbus, Ohio. And he said, "You know, I really liked your wife's speech at Otterbein College commencement." And I said, "Yeah, I did too, but do you remember that we actually gave the co-graduation speak, the co-commencement speak, we both spoke?" And he said, "Well, I really only remember her." So thank you, Cameron, for that. Always lifting up. I appreciate that. So anyway, the story was close enough to accurate. Lisa, thanks for the work you do, and Marcus Stanley, thanks for the work you do. You will hear from my longtime friend and advisor, Simon Johnson, and the work that he does. And you'll like his voice way more than you'll like mine, trust me. And I appreciate so much the consulting that so many of you do within my office. Graham Steele. Graham, put your hand up. Graham was my banking person for a number of years, and then when I became ranking on banking, Graham moved over to the committee and just does outstanding work and should always be one of the people that you run ideas by and talk to and bounce ideas off and all of that. That can be really helpful. First of all, let me tell you why you matter. About 3 years ago, I read an article in the New York Times, a column, and there was a guy named, some of you know this story, there's a guy named Nick Leeson, right? He had a bank called Barings, and he ended up going to prison as a trader, with a D, trader in Singapore, and ended up causing this bank to collapse. But here's what he said in his memoir, that later, after he's out of prison, he said, "Luckily for my fraud, there were too many chiefs who would chat about it at arm's length but never go forward. They never dared to ask me any basic questions since they were afraid of looking stupid about not understanding futures and options." Those of you that are activists in these issues, and that's pretty much everybody in this room, and those that aspire to be, understand that often the people we are up against are people that speak a different kind of language. I mean, they want to obfuscate. They are always a little more comfortable if the regulators and the elected officials and the media and the public don't quite understand what they're saying. They play that game of intimidation from time to time, so we don't ask difficult questions because people don't want to look like they don't understand and don't want to look stupid. Once you get past that and begin asking questions, everything changes. That's what's so important about the work that Lisa does, the work that Marcus does, the work that all of you in Americans Financial Reform and all of you in this audience do, is asking those difficult questions. Afraid sometimes to know that you don't understand everything. I mean, I got on this committee in 2007. I had not had a background in banking. It's a learning curve for everybody in these issues, and particularly those of you that are young, that are in school, that are just out of school, that want to step in and understand these issues. Stay at it, especially young women. I was talking to a columnist today for Time Magazine, Rana Farouar, I think is how you say her last name. And Rana started off as a comparative literature major or something and became a journalist and decided she wanted to tackle economic issues. There aren't many young women that are doing that, so I particularly encourage you to do that. And as you do that, talk about stories that matter to people. My wife and I live in Cleveland, Ohio. We live in a zip code 44105. I tell you that zip code because in 2007, that zip code had the most foreclosures of any zip code in the United States of America. Ohio as a state had more foreclosures year after year for 14 years than we had the year before. So every year we had more foreclosures for over a decade than we had a year before. That wasn't because, in that case, it wasn't people gaming the system so much. It wasn't really some of the things that happened in particularly Florida and California and Arizona in the 2005, 6, 7, 8, 4, 5, 6, 7, 8. It was really an economy where lots of manufacturing jobs were lost. But when you think about these issues and why they matter so much, is think about the human beings what happens to them. And in this town, we use a lot of numbers, and we don't always understand how this equates to people's lives. If you've watched the Lincoln movie, there's a real quick little snippet when President Lincoln's talking to his staff, and they want him to stay in the White House and win the war and free the slaves and preserve the Union. He said, "No, I got to go out and get my public opinion bath." And I asked Doris Kearns Goodwin, who had written one of the many, many, many great books about Lincoln. I said, "Did he say that often?" And she said, "Yeah, he said that from time to time. I got to get my public opinion bath." Well, few of us, and maybe none of us in this body, get the public opinion baths we need. We spend a lot of time hanging around people that dress like this. We spend a lot of time with people of our, too often perhaps, of people in our own demographic, our own social class. And it's so important we hear these stories. And let me just tell you one. Imagine, in this country, millions of people lost their homes. Just to imagine what it might have been like. You're a 12-year-old girl, and you have a 13-year-old brother. And your dad comes home one day and says, "I lost my job." And then, you start cutting back. You can't really you were doing okay before. Then your mom comes home and said she lost her job 4 months later. And then a few months later, and my wife's actually written about this. My wife's a Pulitzer Prize-winning columnist. If you're on Facebook, particularly, you should look. Her name's Connie Schultz. Little advertisement there. But she wrote a story about about pets during foreclosure. First, if you can't feed your pet, you give your pet away. If you've lost your job and are about to lose your house, then when you get foreclosed on, you got to move to an apartment. You got to give your pet away then. And think about the 12 or 13-year-old kid. First of all, their lifestyle changes dramatically. Then they find out when their mom or dad says, "We're going to have to move out of our house," they're going to do something. The bank's going to take it away, however they explain it to them. And they're going, "Well, what school are we going to go to?" "I don't know. We're going to go to school wherever we end up." And all the personal things that happen when the financial community does what Wall Street did in the last decade. And so tell these, as you continue to be activists in these issues and continue to talk to people on Capitol Hill and continue to lobby Congress as activists, as citizens, tell those personal stories of what this has meant to a whole lot of people in this country. Millions of people have had their lives disrupted where you don't know what's going to happen to your children. You don't know what's going to happen to your way of life. You don't know if you're going to be homeless. You don't know if you're going to move into a small apartment where everybody's stepping on everybody else in a bad way. You don't know any of those things. That's why this is so important. 5 million painful conversations, 5 million foreclosures, all painful conversations. Maybe 15 million painful conversations, because in every story there are sub-stories that matter so much. That's why Congress reacted generally in the right way by passing Wall Street reform, because of these stories and because of what's happened to so many people's lives. You had at the same time in 2011, as the law was beginning to be implemented, you had Republicans running for president denouncing it. Newt Gingrich, if any of you under 30 remember his name, it's not really worth remembering that much, so don't worry about it. Newt Gingrich said Dodd-Frank would end up killing small banks, killing small businesses, killing the housing industry. Well, not quite. Since it's been implemented over the past 5 years, the private sector has created 13 million new jobs. Household wealth has grown by $30 trillion. Business lending has climbed 30%. Still not where we want to be. An improving economy. We need to do more, to be sure, on Dodd-Frank. But as we mark this 5-year anniversary next week, I believe it's next week, the 5-year passage of Dodd-Frank, we know what it means. And as Lisa said, polling information, people, as you can look from polling data, people understand this. Americans agree that they overwhelmingly support strong financial regulation. They overwhelmingly support the goals of the Consumer Bureau. This month and for the rest of the year, though, and as long as the Republicans are in control, at least until they realize politically this just doesn't work for them, they're going to continue to attack Dodd-Frank. They're going to continue to find subtle or not so subtle ways to undermine it. We've seen in the Budget Committee. I sit on the Ag Committee. I've seen it there. I sit on the Banking Committee. I've seen it there. We're seeing it in the appropriations process. Last week in Senate Banking, Republicans held another hearing with representatives from the financial industry advocating all kinds of approaches to undermining Dodd-Frank. Tomorrow, Rich Cordray, the head of the Consumer Bureau, will testify before Congress, 54th appearance before Congress, while Republicans say It's not the Consumer Bureau isn't accountable. He's been in front of financial services committees, House or Senate, mostly House, 54 times. This weekend, 2 Republican commissioners on the SEC and the Commodity Futures Trading Commission organizations tasked with policing Wall Street to prevent another crisis, penned an op-ed denouncing regulations. They wrote, one of the greatest potential risks to the financial market is the work of the regulators themselves. Not that the criticism most of us have that regulators didn't do their jobs the way they should have, but just, and that's part of the reason we had the terrible financial implosion, but going from the other direction that these regulators and the regulations should barely exist. I have sat in this committee, in the banking committee, next to Senator Shelby for 7 months now. I have watched one hearing after another when they just seem oblivious to the whole notion, the historical fact, that financial community excess, that Wall Street greed took us into this situation 7 and 8 and 10 years ago, almost as if it didn't happen when you watch these hearings. Their mission is always to find ways, legislatively, by intimidation of regulators, all kinds of ways to undermine Dodd-Frank. 3,000 lobbyists from the financial service industries, 6 for every member of Congress during the Dodd-Frank fight. On the day that the President of the United States signed Dodd-Frank 5 years ago, the top financial service lobbyist in Washington, D.C. said, now it's halftime. Now it's halftime. What they mean? Obviously, what they meant is it's time to begin to lobby these agencies, begin to work, how you doing? Begin to work Congress, begin to do whatever they could to weaken and undermine and do everything they could to straitjacket what regulators should be doing with Dodd-Frank. In 2012, lobbyists for banks outnumbered consumer protection advocates. 20-1, banks have spent literally hundreds of millions of dollars attempting in every way to rewrite Dodd-Frank, to weaken the law, to undermine its enforcement, to blunt its impact, doing all the things they've done. We know the challenges that we have. American consumers have no union to demand a fair wage, to demand a defined pension, no dependable retirement account, to retirement savings for especially people under 50 in this country. The average borrower left college, so many of you are way too familiar with this. The average borrower left college last year with a $30,000 plus $33,000 in student loan debt. Nearly 60% of 18 to 20-year-olds now live with their parents, in large part because of low-paying jobs and student loan debt. More than 5 million Americans still have mortgages that are underwater, representing $350 billion of negative equity. 1 in 5 Americans has an error on her credit report that may prevent her from access to the traditional banking system that they need. 1 in 3 Americans adults has debt in collections, a majority which is medical debt. We know all these problems. That's why what you do matters so much. That's why what we're trying to do to beat back weakening of these financial rules is so important. 57% of Americans say they're not financially prepared for the unexpected, for a medical bill, for a temporary lost job, to a health problem for their child. That's why, again, what you're doing is so important. Let me close with a story, and then I'll take a couple questions if you want, Lisa. Back in March, I led a delegation with a Republican senator from South Carolina. We led the delegation to Selma, Alabama, to mark the 50th anniversary of Bloody Sunday, when Congressman John Lewis, a hero to almost anybody that's ever met him, when John Lewis walked across the bridge and was beaten up in 1965. John was beaten up more than anybody in the civil rights movement, it's believed. John was the youngest person to speak on the March in Washington, 1963 with Dr. King. John was one of the original freedom riders, a half dozen white men and women, a half dozen African-American men and women in 1961. So John's on the plane going down to mark this 50th anniversary, and President Obama joined later at the bridge and spoke one of his best speeches I think he's given in his presidency. But as we were writing down, I was talking to John, and here's the story that I wanted to share with you. Last spring, John Lewis was the commencement speaker at the University of Mississippi in Oxford, Ole Miss. And John, I like that reaction. That's the reaction I was looking for. John Lewis, when he was 20 growing up, as a teenager growing up on a farm near Troy, Alabama, or when he spoke at the March on Washington, or even when he was first elected to Congress 25 years ago, John would never in his wildest dreams thought he would be the commencement speaker at Ole Miss. And here's the story he told. John Lewis looking out at a crowd of thousands, probably 20% black, I don't know, 80% mostly whites from Mississippi. And here's the story John told. He said, John was born in 1940, grew up in a little farm, chicken farm outside Troy, Alabama. He said, when I was a little kid in the 50s, he said, one day I went into Troy with my parents, and I saw these signs that said, whites only, coloreds only, white drinking fountain, colored drinking fountain. And he said, he went to his parents, he said, what does this mean? Whites only, colored only? And his parents said, John, don't ask questions, don't make trouble. So he said, I turned to my grandparents and I said, Grandma, Grandpa, what does this mean? Whites only, coloreds only, white restrooms, colored restrooms. And John said, and his grandparents said, John, don't ask questions, don't make trouble. Then John goes on at Ole Miss and he says, when I was 17, I met Rosa Parks. When I was 18, I met Martin Luther King. And I told them these stories, what my parents said and what my grandparents said. They said, no, John, ask questions, make trouble, make good, necessary trouble. So the lesson is ask questions, particularly when they obfuscate, particularly when they talk in terms you don't always understand. Make trouble, make good, necessary trouble. You will keep this crowd honest. You'll make a huge difference in people's lives if you do. I'd be glad to take your questions. Thanks. Go ahead. By the way, Brad Miller, I didn't see you there. Thank you for the work. Can you identify who you are, if you would? Yeah. You just identify yourself. Yeah. Okay.
Thank you very much, Senator Eric Garcia, National Journal.
Okay.
You and I have mixed a few times. I'm just, 5 years after Dodd-Frank, there still is a concern about too big to fail, with the too big to fail banks. You proposed things with Senator Vedder in the past on too big to fail. What are the big risks in terms of too big to fail? What's the best way to curb too big to fail 5 years later?
I think you first look at bank concentration. And 25 years ago, these numbers are not quite up to date. 25 years ago, the largest 6 banks in this country, their combined assets were under 20% of GDP. Today, they are approaching 65% of GDP, these 6 largest banks. It's pretty clear that bank concentration is not just about economic power, it's also about political power in this town with Congress and with federal agencies and with regulators in the states and federal government, from agriculture to from the CFPB to OCC, everywhere else. I think so one of the things is, we may end up revisiting Brown-Kaufman that Lisa mentioned in the dinner introduction, where the largest banks would be scaled back, would have to divest some of their holdings. I look forward to working with regulators who, as we go through living wills, the whole process of living wills this month, I believe, is when they're going to make some decisions, right, Graham? Will they step up if it looks like these banks are not in a position where they can resolve, where they can go through resolution authority and protect the system, that the Fed and other regulators can order that these banks begin to scale back the size? It's clear they're not just too big to fail, they're too big to, they're by and large, they're too big to run and too big to regulate, too big to manage. I think we've seen that. Ultimately, does the Justice Department move forward on making people responsible individually, corporate executives responsible for this, where they're going? And I think Brown-Vitter, as we continue to revisit that and continue to discuss that and debate that, I think over time, I think that's contributed, as the speaking out of many of you have done, for stronger capital standards. I don't think we'd have capital standards as good as they are now. They're not good enough yet, but as good as they are now, if it hadn't been for the debate swirling around not just Brown-Vitter, but the discussions that so many have had on fixing much of this could have been done 10 years ago by higher capital requirements, which we failed to do, but we need to move more in that direction. Yes, sir. Or do you want to call on them? Okay.
Thomas D. from Capstone, we're a policy analysis firm in DC. Clearly, Democrats in the Senate are not supportive of using bank regulations for the largest banks, but recently you
First of all, thank you. If I can kind of shorten this as much as I can, when Senator Shelby brought out his quote-unquote reform bill, which is one of those efforts to weaken many aspects of Dodd-Frank, it included major changes in the Fed. It included major changes in FSOC. It went into GSE reform in a way that I don't think made sense entirely, and it answered the concern you raise on the mid-sized banks, the regional banks, but it did it in a way that takes away any real ability for regulators, either the Fed or FSOC or any of the independent actors, to do what they need to do for systemically important financial institution designation for some of the mid-sized banks. Our response to that, every single Democrat on the committee supported efforts, as you suggest, all 10 of us, I guess. I think it's 10. All 10 of us supported efforts to do some regulatory changes on banks and credit unions under $10 billion. We're also willing to look at what we do with the regional banks, the mid-size, sort of 50 to 150 or 50 to $200 billion banks. What do we do there that those banks are by and large not systemically important, but at the same time they can be in the aggregate, and there's certain things they need to do. So as they go, I'm willing to look at, and I think that I can speak for other Democrats on the committee to this point, that all of us are willing to look at what that means for those banks, what it means for going through the process of CCAR and other kinds of ways of testing the strength of those banks in bad economic times. And so I think we're open. I know we're open to change there. How we do it is not clear. I'm hopeful that we can deal with the smaller banks first, and then look where we go there. But our fear is that anything we do, that unless Senator Shelby and I have an agreement that we're not, that, to oppose amendments that would further weaken Dodd-Frank in a way that's unacceptable, I think, to the stability of the financial system. That's got to be a major prerequisite in anything we do. All right, thanks, Lisa. Thank you all.
Regulators up, and while we do that, there's a couple of seats scattered here in the front and both sides, and so if people could find them as the next panel is coming up, that would be great as well. There's at least 3 or so over there and another 3 or 4 over here.
You've been in DC for the last couple of decades? Okay.
Paul, Jonathan Marcus.
Hey, Paul. How are you? Good to see you. They drag you into this.
Hi, Jonathan Marcus. Nice to meet you.
Hello. With the AFL-CIO Office of Investment, I'm moderating the panel.
Okay. Jonathan Marcus.
Mark Andrew.
You. I'm just trying to figure out if Lisa's opening or if she wants me to introduce her. Hi, everyone. Hi. I'm Heather Slavkin-Korzor. I'm the director of the Office of Investment at the AFL-CIO, and I'm going to be moderating this panel of regulators this afternoon. Before I get started, I just want to thank the AFR folks, Lisa and Marcus and Becky and Jim and Aaron and all of the people who have worked tirelessly, not just in the last 5 years, but in fact to pass Dodd-Frank and to protect it in order to ensure that it continues to serve the function that was intended when Congress passed the legislation 5 years ago, and protect working people and consumers from tricks and traps in the financial markets. Joining me today, I have, maybe you guys can just wave as I say your name so that we know who you are. To my immediate left, I have Zixta Martinez, who's the Associate Director for External Affairs at the Consumer Financial Protection Bureau. We have Paul Nash, the Senior Deputy Comptroller and Chief of Staff for the Office of the Comptroller of the Currency. Jonathan Marcus, the General Counsel for the Commodities Futures Trading Commission. Patrick Pinschmidt, the Deputy Assistant Secretary and Executive Director of the Financial Stability Oversight Council at the Department of Treasury, and Mark Vanderweed, the Deputy Director of Bank Supervision and Regulation for the Federal Reserve. So thank you guys all so much for joining us today. We have a lot of questions that we'd like to ask you guys, so we'll go ahead and get started. The first question is a question I want to open it up to any of the participants, and it's general, but I think you guys will have a lot to say. And that's, what is the single most important Dodd-Frank related achievement that your agency has actually implemented over the past 5 years? What difference is it making in the real world? And then, what is the single most important piece of Dodd-Frank related unfinished business that is facing your agency, and what is the timeline for addressing it, and what barriers have you guys faced in implementation? So,
deviate slightly from your proposal. As I was told, we were to provide remarks and then engage in Q&A, but my remarks do answer those questions. So I want to first start by thanking everyone for joining this, and to thank AFR in particular for reaching out to Director Richard Cordray and the Consumer Financial Protection Bureau to be a part of the 5th anniversary celebration of the Dodd-Frank Wall Street Reform and Consumer Protection Act. It's really delightful to see so many friends in the room. I know how involved many of you were in the passage of Dodd-Frank and in the creation of the Bureau. I especially want to thank Lisa Donner for her steady efforts in leading such a large, diverse, and significant coalition of stakeholders, one that has consistently encouraged the CFPB to fulfill both the spirit and the mandate of Dodd-Frank. For today's discussion, I thought it would be helpful to provide an overview of some of the work we've been up to since we opened our door 4 years ago. Many of you deserve a great deal of credit for helping the Bureau to arrive at this point. As you know, the CFPB was created in the wake of the financial crisis to stand up for consumers, make sure they're treated fairly, and restore trust in the consumer financial marketplace. In the decades preceding the financial crisis, authority for consumer financial protection laws was delegated to 7 separate federal agencies, none of which had the effective tools to oversee the entire consumer market. So we're a relatively new federal agency, but we've not squandered our youth. Here's some of what we've been up to in the last 4 years. Through our consumer complaint function, launched in 2011, we have handled over 650,000 complaints in multiple languages about credit cards, mortgages, bank accounts and services, student loans, credit reporting, money transfers, debt collection, prepaid cards, payday loans, vehicle and other consumer loans. In many cases, companies provide relief to consumers, either money back in their pockets or things like correcting their credit report or stopping harassing phone calls by debt collectors. Our consumer complaint database generates a rich trove of information from individual consumers in real time about the most urgent problems and challenges consumers confront in the financial marketplace, all of which informs our supervisory and enforcement work. In March of this year, the Bureau launched a new feature of complaint database which allows consumers to opt in to share their complaint narratives, which we hope will shine a light on some of the most problematic practices in various marketplaces. More than half of the consumers submitting complaints have opted in to share their narratives, which are then de-identified to protect privacy. In addition to our consumer complaint function, we've developed many other consumer resources to promote informed financial decision-making, including Ask CFPB, an interactive database of more than 1,100 commonly asked consumer financial questions and answers. We've developed CFPB in Espanol with relevant information and resources in Spanish. We have continued to develop the Your Money, Your Goals toolkit. This comprehensive guide is designed to be used by trusted public and private sector intermediaries, such as social workers, legal aid attorneys, and volunteers. We've partnered with the Department of Education to create a financial aid shopping sheet, which is now being used by more than 2,000 colleges and universities. As many of you know, much of the Bureau's early regulatory work centered on the mortgage market, a primary cause of the financial crisis. We issued a number of mortgage rules that today provide guardrails for consumers and the mortgage market as the mortgage market continues to recover. Our ability to repay rule, also known as the Qualified Mortgage Rule or the QM rule, prevents the kind of irresponsible underwriting that precipitated the crisis. Our mortgage servicing rules offer new and stronger protections to homeowners facing foreclosure. And our other mortgage rules address significant problems in the mortgage market that sorely needed repair. We're also finalizing a proposal we published in December 2014 that would create comprehensive consumer protections for a range of prepaid financial products, including general-purpose reloadable prepaid cards and certain digital and mobile wallets. In March, we released an outline of proposals under consideration aimed at ending payday debt traps by requiring lenders to take steps to make sure consumers can repay their loans. We are also developing proposed rules concerning debt collection. We received more than 23,000 comments in response to the debt collection AMPR. That's just some of our regulatory work. In addition to our rulemaking efforts, the Bureau continues to make progress in our supervision and enforcement work. To date, enforcement activity has resulted in approximately $10.1 billion in relief to more than 17 million consumers who were victim to various violations of federal consumer financial laws. Examples of enforcement measures include an action that resulted in $727 million in relief to consumers who were harmed by a company's deceptive marketing of credit card add-on products. It includes an action that resulted in $92 million in debt relief for 17,000 service members and other consumers who were harmed by a predatory lending scheme. It includes an action that resulted in $70 million in relief for consumers who were harmed by unfair billing practices. Our supervision program continues to engage in the important work of examining entities under our authority, and where violations have occurred, supervised entities are directed to implement appropriate corrective measures, including remediation to consumers as appropriate. Our supervision program continues to be refined, improved, and expanded. We consult and collaborate closely with our fellow regulators, as well as with state regulatory officials to carry out our work. Part of our responsibility is to address consumer financial issues in an even-handed manner across all market participants. We continue to build out our risk-based supervision program both for banks and for non-bank financial firms. That approach is enabling us to provide more consistent treatment that ensures compliance with federal consumer financial laws and helps level the playing field among competing bank and non-bank firms. Our work at the CFPB is still in the early stages. In standing up the new Bureau at an almost breakneck speed and working to fulfill our congressional mandate, we have high expectations for our work, and we know that you do as well. As the American economy recovers, we want consumers to be able to look ahead with hope and resilience. We want them to know they have a new agency standing on their side and looking out for their interests to help restore confidence and trust in the consumer financial marketplace. Thank you, and I look forward to additional discussion.
Thank you, Zixta. It's always really exciting to hear about all of the fantastic work the CFPB is doing. I definitely think that for those of us who fought hard to make sure that we would have a CFPB, it's great to see that you have not squandered your youth at all. Before we move on to questions, is there anybody else who prepared remarks that you'd like to present? Okay. All right, well then let's go back to the question we started with. What is your greatest achievement in implementing Dodd-Frank, and what difference do you think it's making to real people as opposed to the fake people that live inside the Beltway? And then what's the single most important piece of Dodd-Frank related unfinished business that faces your agency, and when are you going to get it done?
Yeah, I'm happy to jump in. So picking up a little bit on what Zixta was saying about the mortgage rules, I think I'll talk about two rules that we've done, and hopefully I won't overlap too much with what other folks want to talk about. And the first one relates to mortgages as well, and that's the risk retention rule. So risk retention was an enormously complex undertaking because of the vast interagency process, which Dodd-Frank put us in for a lot of the significant rulemakings we did. But again, going back to the origins of the financial crisis, one of the key elements was that there was no underwriting going on, and nobody seemed to really care about it. So the market that developed, which involved sort of, fly-by-night operators issuing mortgages and selling them right into the marketplace, they had no interest in care. They had no real interest in whether or not those mortgages would ever pay. And as those mortgages worked through the system, that created an enormous amount of instability in the system, and someone inevitably would be left holding the bag. So there are lots of different aspects to that, in terms of folks who were taking mortgages that they couldn't repay, and folks who were buying stuff without knowing what it is they were buying. But the initial flaw in the entire system was that there was no underwriting being done at the first stage. And so risk retention was really intended to address that, in my view. This took maybe 4 years for us to get risk retention out. There's some in the audience who can remember the exact dates better than I can. At one point, we had an interagency proposal that over 400 members of Congress told us we got wrong. So we did something that rarely happens in Washington. We united Congress against us. But we came out with, I think, a really good rule that will require better underwriting. And I think that's a real core element of what we were trying to accomplish in Dodd-Frank and what risk retention is all about. So if you're going to originate or securitize a mortgage, to be more precise, you've got to hold a piece of it. And there are exceptions and different things that go into that. But the fundamental principle is if you write it, you own it. And I think that's a really core reform that will help promote financial stability. The other rule, the mission accomplished, that I want to touch on is a smaller rule, but it relates to a bigger principle. And again, one of the things I think we learned from the crisis was that capital really matters. And what we want to do is enhance both the quality and quantity of capital in the system. So most of the capital work, as you all know, comes through the Basel process, which is non-Dodd-Frank. So I won't talk about Basel at all. But there was a really important amendment in Dodd-Frank that did get to capital, and that's the Collins Amendment, which set a floor for capital across the boards of different types of financial institutions. And so there was a rule that the banking agencies worked on to implement the Collins Amendment, and that helped set a floor that I think, again, gives us a solid foundation on which to build out the capital requirements that come from Basel and from our own deliberations as we try to enhance, again, the stability and resiliency of the financial system. So through supervision and other tools that supervisors have, we would hope that we would be able to help avoid another downturn. But we all know none of the elements that we're putting into place are perfect. And to the degree we miss the mark or the industry misses the mark, a robust capital system will help weather that storm. And so the Collins Amendment, I think, is a really core foundation of providing that robust capital system. When I think about what we haven't done, one of the rules that we're very engaged in now and that I hope we can bring to a close sometime soon, and soon in the regulatory world is a very relative term, is the compensation rule, which we've seen, again, another one that we have proposed and are in the process of trying to bring to a close. So compensation, again, would help set standards. So we don't want compensation to drive bad decision-making or inherently risky decision-making. So again, looking at the compensation systems that were prevalent prior to the financial crisis and what we've seen in other jurisdictions around the world as a result of it in our own review, we're looking to develop a compensation system that would prevent the race to the bottom mentality, which has, I think, challenged the industry during certain periods. A system of compensation that will reinforce the proper risk culture that we're trying to drive, and to ensure that key decision makers across the industry also have skin in the game, which is a theme that I seem to keep coming back to. Right, the more you're tied to long-term outcomes, we think the better long-term decisions we'll see. And when compensation is tied to short-term outcomes, we will see short-term decision-making and short-term risk-taking that may be antithetical to long-term stability. So that's, I think, at least for the OCC, and I'm sure other agencies, one of the ways we're looking at the compensation rule, which again is unfinished business, but I'm hopeful that with the continued effort, and it's really been in the front burner quite a bit, that we can get there hopefully this year.
Thanks. I'm Jonathan Marcus from the CFTC. The single most important achievement, broadly speaking, for the CFTC is the standing up of a regulatory regime for swaps. 5 years after the passage of Dodd-Frank, the CFTC has nearly completed its implementation of the tax swaps reforms, and the previously unregulated swaps marketplace has been totally transformed. First, a large majority of swaps transactions are now centrally cleared. Second, a substantial number of swaps are trading transparently on regulated platforms. Third, a vast amount of swaps data is being reported, and the price and volume of that data is publicly available. And fourth, over 100 swap dealers and major swap participants are now registered with the CFTC and subject to our oversight. But if I had to single out one area of swaps reform as the most important, I would choose clearing. Central clearing of standardized swaps lowers risk to the economy. Central clearing protects counterparties from the risk of the other party's default and reduces the risk that arises from the interconnectedness of financial entities. Clearing houses have reduced the risks in the futures market since the late 19th century, and they are now doing so for 21st century swaps. Since its rollout in early 2013, the CFTC's clearing mandate has had a major impact on the swaps market. As a result of Commission rules mandating clearing for most interest rate and credit default swaps, the percentage of swap transactions that are now centrally cleared has gone from about 15% in 2007 to about 75% today. The CFTC has also put into place rules that enhance the clearing process. These rules have eliminated significant time delays. 5 years ago, clearing happened at the end of the day or even just once a week, leaving significant periods of bilateral credit risk in the market. Today, with 99% of swaps clearing occurring in 10 seconds, market participants no longer have to worry about credit risk when entering into swaps trades that are intended to be cleared. So for all these reasons, bringing central clearing to the swaps market has been a historic achievement for the CFTC. As for the most important piece of unfinished business, it's in some ways the flip side of central clearing. While I've just discussed the critical importance of central clearing, the fact remains that there will still be a significant number of swaps transactions that are not eligible for central clearing because, among other reasons, the market for those swaps is not sufficiently liquid. So the CFTC has a proposed rule on margin or collateral for uncleared swaps that will be a critical tool to mitigate the risk of counterparty default and the potential risk to the financial system as a whole. In developing our proposal last fall, we worked closely with the banking regulators and will continue to do so as we move towards a final rule in the coming months. The banking regulators have the responsibility to issue rules for those swap dealers that are banking entities under their respective jurisdictions. Swap dealers that are not under their jurisdiction are subject to the CFTC's rules. We are also working on the cross-border application of the margin rule for uncleared swaps. Just last month, the Commission voted to issue a cross-border proposal that is very similar to the banking regulator's proposal, and it was published in the Federal Register today. You asked about roadblocks. There are certain factors that have affected our timeline. We originally proposed the margin rule back in 2011, but subsequently the Basel Committee on Banking Supervision and the International Organization of Securities Commissions issued a new international framework for margin on uncleared swaps. Our reproposal last fall took into account the Basel IOSCO standards. Another factor in the timing is the complexity and global nature of the swaps market, requiring consultation with foreign regulators in addition to our domestic counterparts. While we may all share the common goal of protecting the markets from the risks arising from uncleared swaps, each party comes to the dialogue with its own perspective on how to achieve its goals, shaped by its own regulatory philosophy and its supervisory experience. So we are making good progress with our fellow regulators, and we do anticipate finalizing later this year. Thank you.
Thanks. So I guess just stepping back for a minute, I mean, if one thinks of Dodd-Frank, what the aim of the law was, it was a comprehensive response to filling a series of regulatory gaps, whether it's the CFPB on the consumer side, CFTC with swaps. And the role of the FSOC is somewhat novel in creation in Dodd-Frank. That was the response to the getting regulators together to coordinate and have a mechanism to respond to risks to financial stability. So kind of stepping back and thinking back over the last 5 years in terms of what FSOC has achieved, I'd highlight two key things. I think the first is the success in operationalizing the council. Clearly Dodd-Frank gave the council certain authorities, but there was also a lot of discretion as to how it could use those authorities. So it was not really clear, if you think back 5 years on the spectrum of outcomes, how it would shake out. And certainly cynics at the time wondered, do we really need another book club for regulators? And I think, in hindsight and, looking back now 5 years later, I think it's very, very fair to say that, the council has succeeded in becoming a serious forum for regulators to do deep analysis, to engage, to collaborate, and when needed, to address risks to financial stability. The second point I'd highlight is, I think the council has done a good job in prudently deploying a broad range of tools, different tools for different types of risks, being methodical, being deliberative. You see this in sort of company-specific risks. In the case of non-bank financial institutions, the council took 2 years and 3 rounds of public comment to develop a final rule on non-banks designations. With the FMUs, financial market utilities, which serve as the plumbing of the financial system, whether they're derivatives clearinghouses or payment systems. The council also submitted its proposal to public comment and later designated 8 FMUs, in addition to the 4 non-banks it's designated. But that's company-specific tools. In addition to those tools, there are a broad array of industry or activity tools. And I think, at its heart, the council is about data sharing, increasing transparency among regulators as well as to market participants, and when necessary, working with individual regulators on certain problems, and to the extent if it's needed, actually proposing a formal recommendation to a regulator for heightened prudential standards, as the council did with money market funds back in 2012. And then finally, there are areas of risk where or potential risk where there isn't really a lot of information out there and more work needs to be done. And you're seeing that with the council's asset management Federal Register notice that was put out in December on asset management products and activities. This is basically a vehicle to engage with industry, to engage with stakeholders on questions relating to potential areas of systemic risk. And then finally, each year the council publishes an annual report. This outlines key areas of concern, potential threats, recommendations by the council to address those threats. So again, in all, I'd just highlight the comprehensive array of tools that the council has used over the last 5 years.
Okay. From my perspective, that might be better. Speaking only for myself and not for the Federal Reserve, I would say our greatest accomplishment has been increasing the resiliency of large banks. And this is using a variety of authorities, including some of the new authorities that were given to us under the Dodd-Frank Act. One of the key lessons learned from the crisis was that large banks domestically and around the world did not have sufficient capital, did not have sufficient loss absorbency, and did not have, had excessive liquidity risk and excessive levels of short-term wholesale funding. So we at the Fed set out both internationally and domestically, internationally through international organizations such as the Basel Committee and the Financial Stability Board, and domestically with our colleagues, in particular at the OCC and the FDIC, to raise capital requirements for large banks and to impose liquidity requirements for the first time on large banks. So on the capital side, we've raised the minimum amounts of capital that would be required of large banks. We've increased the quality or the purity of what counts as regulatory capital for large banks, and we've smartened up the risk weightings on the assets that we have for large banks, including through the Collins Amendment in the Dodd-Frank Act that Paul mentioned. So we've done a lot to raise and strengthen the capital requirements for large banks. At the same time, we've also adopted a stress testing regime, which is again a part of the Dodd-Frank provisions as well, so that not only are large banks now in the U.S. required to meet their capital requirements on a point-in-time basis, but we also do some analysis to forward project how their capital ratios would move if they were hit with a severely adverse economic scenario and market shock, to see what their capital ratios would look like then, and to ensure they're capitalized not just for the current, what might be benign conditions, but they're also capitalized to deal with malign conditions that might come in the future. We've also decided to impose extra capital requirements on the very largest banks, what we call the systemically important financial institutions. So both for our simple leverage ratio and for our more complicated risk-based capital rules, we finalized a surcharge for the big banks on the leverage ratio already, and we proposed to adopt surcharges for the most systemic firms on the risk-based rules as well. At the same time as increasing the capital requirements on big banks, we've also, for the first time, adopted liquidity requirements for the big banks. So these would require banks that have a lot of unstable short-term wholesale funding to also hold a lot of high-quality liquid assets to offset the risks of that kind of funding. And overall, in general, put constraints on the amount of liquidity risk or maturity transformation that large banking organizations can take. And we've done this through already the liquidity coverage ratio that we've adopted in the U.S., and we're working on a net stable funding ratio, which is a little longer-term liquidity risk regulation that will be coming shortly. We've also used supervision as well to constrain the risks of large banks. And again, borrowing from some of our Dodd-Frank authorities, one of the provisions of the Dodd-Frank Act was a directive to the banking agencies to be a bit more macro-prudential focused in our regulation, to think about financial stability risks. So not just ensuring the safety and soundness of individual financial firms, but also to look more broadly at the interconnections among individual financial firms and how individual financial firms relate to the broader financial system more generally. So we've been doing that as well through more intensive supervision, more forward-looking supervision, and supervision that's more macro-prudential in nature or attendant on the financial stability risks of the firms we supervise. On the unfinished business side, I would say while our most significant achievement has been lowering the PD, or the probability of default, of large banks, I think the unfinished business I would point to would be reducing the LGD of our largest banks, or the loss given default. So if a big bank fails, how much damage will it do to the system? We've made a lot of progress on that already. The Dodd-Frank Act made a lot of progress on that by creating a new orderly liquidation authority in Title II. We've been helping the FDIC build out that particular resolution regime. But at the same time, we're also working on the Dodd-Frank Act living wills that come in through Section 165D of the Dodd-Frank Act, which require the largest banks to show how they can be resolved in an orderly way under the bankruptcy code. So we're also in train on that work. But that's going to require a significant amount of energy of Fed staff and Fed principals and FDIC staff and FDIC principals in the coming months and years as well. And we also have some, I think, structural reforms that I think are going to be relevant to make the firms more resolvable. And you've heard many Fed governors talk about a long-term debt requirement for our largest, most complicated banks. We think that's going to be a necessary component of the broader big bank regulatory regime. We've been working on a version of that at the Financial Stability Board level, but we've also been working domestically with the FDIC on a domestic implementation of that sort of a regime. And that's it for me.
Heather, if I could just add with respect to unfinished business at the Bureau, in addition to the proposed rulemaking in the pipeline, in January of 2013, we promulgated mortgage servicing protections, and in 2014, they became effective. Since then, we have met with mortgage servicers, housing counselors, bankruptcy attorneys, a wide range of stakeholders who have on-the-ground experience with what's happening in the mortgage servicing market. And we, in December of 2014, proposed additional amendments to the mortgage servicing rules, which would address some of the more acute issues that we saw unfold after we promulgated the mortgage servicing rules. So we expect to finalize those in the early spring and address concerns related to successors in interest, concerns related to the transfer of servicing rights, and we expect to add additional protections to prevent the dual tracking problems that continue to be seen in the servicing market.
Great. Well, thank you. So the next question I have is related to the FSOC agency report that was just released on market structure and liquidity, including the disturbance in the Treasury market that happened last October. Excuse me. The report highlights emerging market risks, such as principal high-frequency trading firms, but we've also seen people claiming that market structure changes due to new Dodd-Frank regulations threaten market liquidity. Can you tell us about the conclusions of the report and what they say about both the level of liquidity-related risks and whether these risks are due to Dodd-Frank regulations? And I'm hoping that Patrick could start us off in response to that question, put you on the spot a little bit.
Thank you. So I think there are a couple things at play here. There are two different reports, and I can talk to them. There's the report that was issued yesterday, which was the interagency report on October 15th, in the Treasury market, the events where you had the round trip and the 10-year. And then there was the FSOC annual report back in May that talked more generally about market structure changes. So first on the report yesterday that was released, this was an interagency report, again, looking at the events of October 15th, 2014. It was put together by Treasury, by the Federal Reserve Board, New York Fed, SEC, and CFTC. So it was an interagency report distinct from the FSOC process. I think the key finding there was, and again, the report's characterized as preliminary because there's still ongoing work being done, but there was no single factor to explain why prices round-tripped that day. I mean, clearly, there's a lot of information, there was a lot of data brought to bear, there's a lot of discussion about the changing nature and the changing roles of different market participants, whether it's electronic players or traditional broker-dealers. And also, and related to your question, there was also no regulatory link in terms of what happened that day and what's going on in the markets in terms of what related to Dodd-Frank. But in terms of next steps, because this is really clearly an ongoing area of interest both at Treasury and other regulatory agencies, is it's important for regulators to continue to understand and study the evolution of the Treasury market. There are a lot of changes on the ground in terms of the players, increased electronification, the role of traditional broker-dealers. The report also does note that increased attention to trade and risk management practices at the different sorts of players in the market. That would be an important thing to do, as well as understanding the current regulatory regime and what certain changes or enhancements might be appropriate. And finally, and this certainly hits to FSOC in terms of kind of, it notes also the need to share more data and to strengthen interagency coordination on the Treasury market, because it is there are different overlapping jurisdictions on the Treasury market, and so just getting folks to work together more. The FSOC annual report, which was a separate report and kind of broader list of recommendations from the Council that was put out in May, echoed some of these general themes, and not just applying to the Treasury market, but more broadly different market structures. And this was a new recommendation this year. And basically, what the report noted is that there have been some changes in market structure going on, some of which have predated the crisis, others which have accelerated post-crisis. And it's important for regulators to understand how these changes in market structure are impacting market functioning, as well as the provision of liquidity. And when we think about changes in market structure and changes in market functioning, this is obviously a key core area for Treasury Department. Just yesterday, Antonio Weiss, who's a counselor to the Secretary, put out an op-ed in the Wall Street Journal on this. And as we look at some of these changes, and again, I'm not speaking specifically to the Treasury market, I'm speaking across markets, there seem to be three kind of factors at play here, and they're very hard to disentangle as to what's more important. But certainly there are cyclical factors at play. We're at a stage in the interest rate environment where we haven't had a rate increase in almost 10 years. It's a low for long period. Short-term rates are near zero. Clearly that it exacerbates a sort of directional market. It limits the need for hedging, and it limits the need for certain trading activities. So there's a demand side issue based on cyclical factors. There's also electronification. And again, this dates back to the 1990s in the equity markets, and then the last decade more in fixed income, in futures, and now we're seeing it broaden to other fixed income markets, including the Treasury market. What electronification does is it obviously increases the velocity of trading, but also trade sizes become smaller. And there are also potential operational issues associated with electronification. And then finally, the third factor is the shifting roles of the different players in the market. You've seen an increased role by the buy side in terms of active in certain markets, whether it's the corporate bond market or other markets. And you've also seen a different role from the broker-dealer community, the sell-side community. And again, trying to disentangle all these factors and understand what the key driver is not an easy task. But certainly the view at Treasury is it's an oversimplification to cite regulation or any one factor as driving changes in market structure or liquidity. But it's certainly an area of ongoing focus by the regulatory community.
Thank you, Patrick. Does anybody else whose agencies were involved in that want to jump in on this question? All right. So the next question we have is for the banking regulators and for the FSOC. This panel follows opening remarks by Senator Brown, who, with Senator Vitter last Congress, as he discussed in his opening remarks, sponsored legislation that would have instituted substantially higher capital requirements for too-big-to-fail banks. And Senator Warren, who just last week reintroduced the 21st Century Glass-Steagall Act with Senator McCain and others, will be speaking at the end of this event. So there's a lot of interest in doing more to end too big to fail. Of course, Dodd-Frank gave your agencies many tools to use to address the too big to fail problem, and you've been working to implement those tools. So where do you guys think we stand in that effort? Where have we seen progress, and what work remains to be done?
I'll start on that one. So the Fed's pretty deeply, profoundly committed to attacking too big to fail. It's a pretty pernicious economic phenomenon. The extent market participants have a perception that certain large financial institutions are too big to fail, they will have cheaper funding costs. That creates additional systemic risk for America. That creates additional incentives for the largest firms to get yet larger and provides a competitive disadvantage to smaller firms. All of those collectively are a pretty significant negative element, so we're deeply committed to doing what we can with the powers that we have to fight against too big to fail. I think the Fed and the other global and domestic regulators have done a lot of work to attack too big to fail already. Some of the reforms that I already mentioned about reducing the probability of failure of big banks go a long ways towards forcing those firms to internalize the damage that their failure would do to the financial system and to absorb any too big to fail subsidy that is still out there. We're also continuing to do work, as I said, on the resolvability front to reduce the systemic footprints of these firms to make them less damaging to the system when they fail. That work, I think, is ongoing. More work remains to be done, as I mentioned before. But I think also just our general work through the Dodd-Frank provisions and through our non-Dodd-Frank work collectively as regulators to make the broader financial system more resilient is pretty helpful in that regard too. So the swap central clearing requirements that Jonathan mentioned, and the swap margin requirements that Jonathan mentioned, increasing the resiliency of central counterparties, risk retention requirements for the securitization markets, all of that work collectively, I think, makes the system more resilient to the failure of a single large firm, and thus I think reduces any too big to fail phenomenon that may exist. So I think we've made a lot of progress. I think we still have some more work to do, but I think the story is pretty good and the trend line is pretty positive.
So yeah, I'd echo what Mark said. I think it's important to keep in mind as a matter of law, the Dodd-Frank Act ended too big to fail by preventing taxpayers from bailing out another financial institution. But I think looking about it more practically in the sense of what the tools are available to regulators, as Mark said, you can think of it in several different ways. One is making failure less likely to the extent that higher capital, less leverage, restrictions on certain activity, transparent derivatives markets, that all helps the system and makes failure less likely. But to the extent failure does happen or bankruptcy does happen, there are common sense tools for regulators to manage that failure, whether it's orderly liquidation authority or other tools to limit the sort of the transmission of stress to the broader financial system and ultimately the economy. And we should remember that this is not just a bank issue, it's a non-bank issue, particularly looking at the crisis in 2008. And Dodd-Frank Act provided certain tools to the FSOC in terms of designation of non-bank institutions for Federal Reserve Board supervision and enhanced prudential standards, including living wills and associated mechanisms.
I think I agree with what my colleagues have said. Dodd-Frank really addressed too big to fail in Titles I and Title II. And what we saw during the financial crisis was the privatization of the gains and the socialization of the losses, which was an untenable situation for any nation to be in. So a paramount goal of Dodd-Frank was to prevent that from happening again. And we saw it through the enhanced authorities that the Federal Reserve has and that the FDIC has in terms of resolving the entities. And we've talked about the other parts of Dodd-Frank that enhance our capacity to strengthen the overall financial system to reduce the likelihood of failure. From the OCC's part, as the regulator of the largest banks in the country, so a significant piece of those entities regulated or overseen by the council. So we have also streamlined and enhanced our supervision of the largest banks through our heightened expectations program, which adds increased capital, horizontal supervision across the firm. So the traditional bank supervision model has been to look at each institution on an institution-by-institution basis. And now we're developing and implementing horizontal reviews across all banks so we can see trends as they emerge. So something that might seem acceptable in one institution, when you see it across the board at many large institutions, might become alarming. We'll be in a position to see that sooner and respond more quickly. So it's all of the different pieces of Dodd-Frank, from supervision to resolution authority to liquidity requirements, capital requirements, and all of it to create a stronger system and the ability to spot problems sooner rather than later and hopefully head them off.
Thanks, guys. So one of the key lessons of the crisis is that there is a very close connection between financial stability and the quality of consumer lending. Can you guys talk about some of the ways that failures in consumer financial protection impacted the markets you oversee before the crisis? And how has the CFPB helped to mitigate the risk that predatory practices can create in the markets you oversee? And then to pose it a little bit differently in the hopes that Zixta will also respond, from the CFPB perspective, how are you ensuring compliance with consumer protection rules, especially ability to repay across the financial system, including both banks and non-banks? And how do you work to create a level playing field for consumer protection? So maybe you can start with that one, and then we can allow the rest of the regulators to respond to the first question.
As you know, the CFPB has supervisory examination authority over the largest banks and credit unions with $10 billion in assets, and that includes about 140 depository institutions. We also have non-bank supervision authority that is plenary with respect to mortgage origination, mortgage servicing, mortgage brokers, with respect to payday lenders and private education lenders. That non-bank authority allows the CFPB to conduct supervision and examination work by product lines, so that we do not have a distinction with respect to how we supervise in banks or non-banks. And that is a very important mechanism for leveling the playing fields. We're examining in non-bank mortgage servicing and bank mortgage servicing entities, and similarly across the range of mortgage activity, using the same scoping and the same examination and the same research approaches. And that has gone a great deal to ensure that the honest businesses no longer have to compete with unscrupulous entities.
Thanks, Zixta. So then going back to the previous question, how has the CFPB helped to mitigate the risk that predatory practices can create in the financial markets? Does anybody want to start with that?
I'll jump in. I think if we had this panel 5 years ago, there would have only been 3 of us at the table. And so it's really, noteworthy when we talk about the successes of Dodd-Frank that my colleagues on my left and 2 down on my right, are now in the picture, which is really helpful. So we have an entity focused entirely on consumer protection and bringing that perspective to bear. And we have the FSOC, which is the venue, and I think maybe we'll talk about that a little bit later if we have time, is the venue to bring all of these perspectives together so we can get a clear picture across the entire financial system. So that's really important. So I would say the mere fact of the CFPB's presence enhances our ability to do a better job as supervisors. So more specifically, the enhanced consumer protections that are required under the new rules have helped both the industry and the prudential regulators to focus on, to create a renewed focus on banking culture and on stronger operational disciplines for lending in general, and even more specifically for exception-based lending. So with these rules in place now, we have the ability to bring that to bear as we look at the institutions. Traditionally, the banking agencies have looked at both safety and soundness and compliance. And we continue to share that space with the CFPB. So we have the same supervisory authority for banks under $10 billion, about 1,600 in the OCC's case, and many more for the other banking regulators. But now we've got another partner at the table to bring attention to these and to develop the rules that we can now implement across the board. So I think it's been very helpful. And it creates an environment where we have such overlapping jurisdiction that it's just a sort of a continuous dialogue among the agencies as far as what do these new rules mean, how do we operationalize them, how do they work in the real world, how do we apply these consumer protections in a meaningful way to the industry. So it's been very beneficial. And of course, the CFPB and the OCC sit on the board of the FDIC. So you've got kind of a ready-made environment for 3 of us. The Federal Reserve has to wait until we bring it to the FSOC for discussion. But it's a really, a very collegial environment where we can talk through these issues. And of course, we're engaged with the other regulators in many ways as well.
So I would just pick up on that. Certainly, I mean, the fact that the CFPB is a voting member of the council, that's a clear recognition that there are linkages between what happens in the consumer market and what happens in the institutional market and more broadly on financial stability. I think, you don't have to look too far back to understand that the importance of having proper pricing incentives for risk at every part of the transaction chain, and the problems that created in the crisis in terms of loans not being priced effectively and then creating problems in the institutional markets.
Thanks. All right, so then since we only have 10 minutes left, I'm going to go to the last question. And I want to know from all of you, what financial risks still keep you up at night? Zixta, do you want to start? Since you're sitting immediately next to me, you get called on.
We spend a great deal of time and resources constantly monitoring the consumer finance markets. We work very closely with the range of stakeholders in the consumer financial marketplace, continually talking to trade associations, practitioners, folks in DIs and non-DIs who are responsible for their operations. We look very closely at the data that is publicly searchable at the consumer complaint portal. And we're constantly looking for not the single complaint, but maybe a gathering of complaints that suggest there's new risks materializing to consumers. We are almost compulsive about making sure we're not missing anything. It's a huge market. We're a small federal agency. I think we worry about our ability to ensure that we're not missing any consumer harms. I will say that our willingness and really aggressive listening posture compensates for our size. We think we learn a great deal from the people who are on the ground, both on the consumer side and the industry side, about what's happening in the markets. It is humbling to work at a place where people take listening seriously, and I think that really helps a great deal.
So from the OCC's perspective, we spent a lot of time in the last 2 years talking about operational risk. And so I would say operational risk is the thing that occupies much of our attention. And I'll go into two categories of op risk. One is cybersecurity. We're all watching the news, as far as the OPM hack. But you really, when you think about the various breaches that have happened, it's kind of a drumbeat, right? Target and Neiman Marcus, and now OPM, and some of the healthcare providers. So it's just this ceaseless drumbeat. And there are literally thousands of efforts to penetrate cyber defenses in the financial industry every year, probably more. And so we're very concerned. That's what keeps me awake, is what happens if we have the deposit insurance, so everyone's bank accounts are guaranteed and safe, and that's been a huge part of financial stability in the United States since 1933. But what happens if a cyber attack wipes out all the records, so we don't know who had what in a particular bank? So these are the types of things. I don't want to scare anybody. So.
You're going to keep me up at night.
So these are the types of things we're trying to think through as to what kind of defenses can we put into place. So in the event there is a significant breach, we have backup records so we can reconstitute them. What are the best practices we can bring to bear in the industry? And as we know, as we really know, unfortunately, from the government side, this isn't something where we're holding industry to a standard that we don't have ourselves. We're all equally vulnerable. And so every agency is looking at what's happening out there and doing their best to put cyber protections in place. So cyber is a critical issue. And the other one I want to flag is the Bank Secrecy Act and anti-money laundering. So the BSA, AML requirements are very challenging around the world, as we see within technological improvements and money racing around the globe at lightning speed. And what are the protections that we can put in place, that the industry can put in place to ensure that we're living up to our obligations under the BSA law and protecting the United States from the misuse of funds around the world, be it from rogue nations or from non-state actors who are building their capacity through the international global system. So, again, as some of my colleagues have alluded to, we're very engaged internationally on that front, because these are challenges that we face that extend far beyond our borders. And so we're engaged with our colleagues around the globe in setting up a robust system that can ensure that money is getting where it should be legitimately, but that it's not getting where it shouldn't be illegitimately.
Yes, I would echo what Paul said about cyber threats. To me, that's just a huge concern. We have very large players in our markets, clearing houses and exchanges, and we have core principles that apply to entities that require them to address operational security issues. But I think it's an area that we are focusing on very much now, and going to be working with market participants to make sure they're prepared and in the best shape to to prevent that kind of attack.
So I think staying up night and worrying about risks is obviously one of the core mandates of the FSOC. And certainly the council has been asking a lot of tough questions on this front across a host of different types of risks. And before kind of getting into specific risks, I think it's worth noting that because the council is out there asking these questions, it's certainly become a target for criticism, and certainly as memories recede and the crisis is further in the background, we worry that it's creating some complacency on the role of the council, being able to be out there looking around the corner, trying to connect the dots, thinking about risk, because it's an absolutely vital function in our current regulatory system. So on that front, kind of drilling down on some of the risks, the council put out its 5th annual report in May. And what the report does is it provides a roadmap for the priorities of the council, but it lays out key risks to the financial system and recommendations to the regulatory community and industry as how best to mitigate those risks. There are a host of different risks highlighted. Some of them are recurring risks, and certainly cyber and reach for yield are at the top of that list. In terms of cyber, it remains a top priority for the council. The need for increased information sharing between the public and private sectors, work on technology infrastructure, as well as attention to kind of wargaming, responding to a cyber event and recovering from that cyber event. Reach for yield, obviously, is no surprise given the current rate backdrop. To the extent that there is an interest rate shock or there's a change in market expectations, making sure that market participants and regulators are attuned to potential risks from duration extension, incremental credit risk, all in favor of trying to find incremental yield by taking on more risk. In terms of some of the new risks highlighted in the annual report, CCPs, there's been a lot of talk about CCPs today. Clearly, the role of central clearing is a core tenet of Dodd-Frank, and it's playing a critical role in making markets more transparent. As well as because of that role, it's important that regulators do all they can to maintain vigilance. And clearly there's a lot going on, but the annual report just emphasized increased vigilance on this front. And then, as I mentioned before, sort of being attuned to the evolving market structures across asset classes and understanding how those could impact market function and the provision of liquidity, particularly in stressful market backdrops. But, I'd encourage anyone to read the annual report to get a full kind of menu of the different types of challenges currently in the financial system. But it's also a reminder of the importance of the council having regulators come together, work together to tackle these risks, because many of these risks do not originate within one type of market, within one type of institution, or one type of regulatory jurisdiction, and therefore it's absolutely vital to have regulators come together to address these risks.
Very much agree with that last point from Patrick, that it is critical that the regulators at this table and the regulators not at this table, who are members of FSOC, work collectively to deal with emerging risks. I'm not the emerging risks guy at the Fed. I'm more the structural regulation building guy, so my remarks will differ slightly from those that preceded me, although I'll synchronize with a few of them. We still have some more work to do on reducing the probability of failure of banks. So we still need to finish our risk-based capital surcharges for the biggest banks to get the right amount of capital that we need to see in them. We still need to complete a couple of assignments from the Dodd-Frank Act, single counterparty credit limits for big banks, and early remediation or prompt corrective action requirements for big banks still need to be done. We also have a lot more work still to do on the resolvability front, as I mentioned before, long-term debt requirements for the big banks, living wills, so a lot more work to do and still in the risk constraint set for big banks. Looking beyond big banks, I think it's also important that, again, this would not be a Fed job. This would be a financial regulator writ large job to keep an eye on the shadow banking system. I think it's very clear that the whole system of non-bank financial intermediation in the U.S. economy is a pretty critical part of our financial system and has a lot of value. But it's also important that we have sufficient constraints on systemic risks that emerge in the non-bank financial intermediation space. So I think it's critical for all of us to collectively be eternally vigilant about risks that may be emerging there as we squeeze some of the risks out of the banking system. We need to watch where they're going. We need to make sure that they aren't creating additional systemic risk elsewhere. So that is something that we all need to be doing collectively. On particular areas that I think warrant some focus that we've been focusing on, I'll synchronize with the CCP comments. As Jonathan said in his opening remarks, the move to CCPs is a significant net positive for the U.S. economy. But at the same time, we need to make sure that those kind of important nodes are maximally resilient and maximally recoverable if they get into problems and maximally resolvable if they do fail. I think we also need to just look at the migration of transactions towards the asset management space to make sure that there aren't systemic risks more broadly in asset management. The FSOC has begun the process to do that domestically. The FSB is taking a look at that internationally. I think that's worthwhile work. Hard to tell how any of that's going to come out, but I think keeping a very close eye on the migration of risks in the shadow banking space is a pretty critical collective effort that we all need to be doing.
Well, thank you. Thank you guys all so much for being here and for sharing your extremely insightful comments with all of us. Thanks again to AFR for organizing this, and we will turn it over to the next panel.
Sitting next to you? I know, I know.
So we have to gather everybody back in. The problem is Simon disappeared for a minute, went off to the bathroom. So the moment he comes back in, we're going to have to start gathering people again because What's Her Name goes on at 5 exactly. All right, so
What's the order?
why don't you two guys sit over here and me, Jerry, and Simon will sit
Okay.
over here. And we'll kind of have systemic risk and then
Consumer.
And then consumer, yeah.
Great.
Hey, Jerry.
Hi, Michael.
Thanks for coming.
Sure.
So,
I'm Edmund
Simon,
U.S. Bird. Hi.
there you are. Okay. All right. Let's try and here. I think we'll have the systemic risk side and the consumer side. What's that? Here.
So should I go last?
Yeah, maybe kind of more go last.
How you doing?
Because you are kind of macro. Okay, why don't you move over there?
Should I move over here?
All right. So Jerry's going to go last. So everybody move down one.
Oh. All right.
I guess we're gonna have three of us. We're gonna have three. No, we're not. He's coming to be with us. They're not sending me down there.
So what's the speaking order?
What's that?
What's the order we're going to go in?
I'll go first. You second.
Okay.
Demetria and Jerry.
Okay. And you're showing slides, right? So they're going to put my slides on.
They're right there, but they're going to be hard for us to see, I guess.
And somebody has my slides in there.
Or do you want to follow?
All right.
And your slides will. If you can hold up a sign, yeah. So we're going to have to be done right at 5. And do one last go. We're going to try to. So everybody has to be 5 to 10. I'll cut people off at 10. Okay, so for this next panel, we've heard from the regulators, and now we're going to hear from experts and advocates who may have a slightly different perspective, I think, about exactly the progress we're making on Dodd-Frank. And I'm going to be the both a moderator and a participant in this panel, so sort of a player coach. We do have a very good panel for you today. I'm just to quickly introduce folks. My name is Marcus Stanley. I'm the Policy Director for Americans for Financial Reform. Directly to my right is Simon Johnson, the Ronald A. Kurtz Professor of Entrepreneurship at the Massachusetts Institute of Technology. And Simon also wrote a best-selling book about financial regulation, which is quite a trick if you can pull it off, called 13 Bankers, that a lot of you may be familiar with. Going down on my right is Ed Mierzwinski, the Consumer Protection Director of PIRG, and a lot of you folks may know Ed if it's got anything to do with consumer regulation. Ed is probably an expert on it. And Mitria Wilson, the Vice President of Government Affairs at the Center for Responsible Lending. And finally, closing us off, Jerry Epstein, the professor of economics at UMass and the co-director of the Political Economy Research Center at UMass. That was an important resource for AFR in terms of input on Dodd-Frank when that bill was being constructed. So I want to start off with a presentation here that's a little bit of a preview for a report that AFR will be putting out in the coming days for the 5th anniversary of Dodd-Frank. And that report is really asking, where have we come in the last 5 years in terms of real changes in the financial sector, with particular attention to what I call this model of hypercharged finance. And this is all laid out in even more detail in the report. But that the idea is that the financial sector in the U.S. has been growing very significantly ever since 1980. There's a long-term trend toward deregulation and financial sector growth. But there's a real qualitative shift that occurs around the year 2000, around the time of the Gramm-Leach-Bliley and the removal of the Glass-Steagall restrictions, where we see exponential growth in a variety of trends that turn out to be unsustainable. And those trends include financial globalization, the growth in the unregulated over-the-counter derivatives markets, securities inventories, bank securities inventories, and related market exposure, because the larger inventory you have of securities, the more exposed you are to changes in market prices. Growth in structured product markets. And when you take all of these trends together, you have an enormous growth in the complexity and fragility of finance. And I think a lot of people don't appreciate that this is actually relatively new. This actually really occurred in the 5 to 10 years right before the financial crisis. It's not a fact of nature about our financial system. So I just want to go through just a couple of those trends because we don't really have time to go into the kind of voluminous detail that this deserves, but just a couple of these trends with you very quickly and talk about how they increase the fragility of finance and whether we've really reversed them over the past 5 years under Dodd-Frank. And the first trend here is, I think, one of the most important is the growth in over-the-counter derivatives. And you can see that there's very rapid growth in, this is the global derivatives markets and what's called the notional value of the derivatives market, which is a sort of a metric for keeping track of the size of the over-the-counter derivatives market. And you see a 5-fold growth in this market in 6 years. I mean, that's really remarkable. That's like the time it takes for a kid to go to college, a little longer, but in America, it is. You see 32% growth, 32% annual growth in this market every year on year for 6 years, and that leads to 5-fold growth in the overall market. And this isn't a small market either. Sometimes small markets grow fast. This is an enormous market with almost $700 trillion in notional value. And the lower line there is what we call credit exposure from derivatives. And that's also that's also a very, very important indicator of the derivatives market, because the great thing about derivatives from the perspective of a user of derivatives is you get to make a bet that can potentially be a very large bet without putting up much money up front. But depending on how that bet goes, you could end up earning a lot of money or losing a lot of money. It's very hard to tell in advance how much you're going to gain or lose. And the notional value is kind of a measure of how much we're betting on, but that credit exposure measure is a much better measure of how much we actually owe. So what you see is people ramp up their bets massively through starting in about 2002 or 2003, starting in about 2002, and then in 2006, as markets start to come under stress, we all of a sudden see this enormous growth, these exposures, these bets we made, all of a sudden we owe a lot of money on them. And in fact, we see $3 trillion in new credit exposures, real money that people owe, that materializes over just those 2 years, which is extraordinary. And that's 2.5 times growth in just 2 years. So that's that first market that really blows up and creates enormous stress in the financial market that was really, I think, unexpected. Nobody expected to see that blow up. And we see that post-financial crisis, the growth stops. That's common in all these trends, that after the financial crisis and even before Dodd-Frank, the growth in these markets stops because people understand, I think, how risky they are and are kind of trying to get out of their commitments. But the actual size of this market remains enormous by historical standards. That growth that occurred over just the 5 or 6 years prior to the financial crisis has not been reversed, and it's still there. And by the way, you can see one other thing. If you look at that credit exposure there, in the second half of 2011, you see $1 trillion in credit exposure that suddenly appears. That's the 2011 euro crisis. So the second trend I want to talk about is financial globalization. And what we see with globalization is we see that the global exposures, the cross-border or foreign exposures of U.S. banks steadily grew for many years. But before the year 2000, over the 15 years before the year 2000, they grew by only about 4.5% a year. Then starting around 2000, what happens? Blam, again, they're growing 15% a year. So this is the globalization of finance, and a lot of the events in the financial crisis were driven by regulatory arbitrage across foreign borders. Were driven by situations like in Lehman Brothers, where Lehman's London affiliate could do things that weren't permitted by U.S. regulators. So that globalization really increased the complexity of the system, made the system harder to regulate. And we see that also really has not been unraveled. The cross-border exposures of U.S. banks remain at about 1/4 of U.S. GDP. Before 2000, they never went above about 13%. So this is another trend that has not been unraveled. And by the way, you can see that it even spikes up after the financial crisis. That's U.S. banks trying to take business from stressed European banks. But then with the Euro crisis, they all have to run away again and reduce their exposures. In 2011, I think we came closer to a crisis than people really appreciate. Now, a third trend is bond inventories. And we've been hearing about this a lot in the context of liquidity. And this is about the inventory of bonds that banks hold. So this is not loans. This is not the ordinary commercial loans you make. These are the bonds you hold. And this is just the data on what I call non-government backed bonds, which means these are bonds that the government is not guaranteeing. So they're not GSE bonds. They're not treasury bonds. They're things like corporate bonds and mortgage-backed securities. And we see, once again, these bond inventories are growing at about 6% a year up to 2000, and then they start to grow at 18% a year, and they grow a very large multiple. They grow like six-fold over the years post-2000. And a lot of that is these structured securities, these toxic assets and mortgage-backed securities. And a big contributor to this is the repeal of Glass-Steagall that allows banks to get into bond underwriting in a much more major way than they previously had been able to. And we see a lot of complaints from banks about there's this claim that, well, Dodd-Frank has made us reduce our bond inventories, and this is harming market liquidity. Well, I would say that that market liquidity, before the year 2000, market liquidity really was not dependent on banks holding these gigantic inventories of bonds. And furthermore, when you look at these bank bond inventories, they're still quite elevated compared to historical standards. In fact, most of that decline there, and there is a considerable decline, but most of it is just banks shedding all these mortgage-backed securities and these CDOs that turned out to be a terrible bet. So these are those are three trends, and I think one thing that all those trends have in common is that they increase unpredictable exposures or exposures that banks have that are very hard to predict in advance, because derivatives, you made a bet, you don't know exactly how that bet is going to materialize. You hold large inventories, you're very, very exposed to swings in market prices. You're more globalized, you may be operating under different regulations in different countries, and it may be harder to see what your risks are. And what this is bank leverage. So this is sort of the extent to which you're dependent on borrowed money. And we see in the years prior to the financial crisis, it looked like banks weren't in that much trouble. They had about $20 of borrowed money for each dollar in hard capital, which, believe it or not, for a bank is not considered all that outrageous. So it seems like we don't have these exposures. These exposures aren't that serious. But it turns out they're hidden, and they materialize very, very rapidly on banks' balance sheets starting in around 2006 and 2007, and they skyrocket up to about a 50-to-1 leverage ratio. And then in the post-Dodd-Frank period, we see that I think regulators and banks really have done a lot of work on reducing leverage ratios. There's been a lot of effort put into this. But you have to ask, before the crisis, with the increase in complexity of the system, we had a lot of hidden exposure. Are we so sure that our problem is solved now? Or how many hidden exposures remain out there given the complexity of the system, which, as I said, have been sustained? So I'm going to try to wrap this up quickly, but just some observations that the growth has stopped and it's even been reversed mildly. But except for some areas of structured finance, private mortgage-backed securities, the developments leading to the financial crisis, these markets are still much larger and more significant, even than they were in the late 1990s or 2000 or 2001, even than they were relatively recently. And that there's kind of this back to the future quality of criticisms of Dodd-Frank, that these changes that happened over just 5 to 10 years prior to Dodd-Frank are somehow necessary to the economy, and we have to sustain them. That our banks have to be highly globalized, that we need enormous derivatives markets, that liquidity conditions should look like they did just pre-crisis. And I think the regulatory challenge here is, given that we've sustained the complexity of the system in so many ways, we've got to keep pace in a regulatory sense with a system that remains very complex and fragile. And I think just two quick things to mention here. I think stress testing is really, really crucial to that, because stress testing helps you keep up with complexity by asking what-if questions. What if something happens? What if an unpredictable thing materializes? And it makes you take a forward-looking approach on trying to predict risk. But stress testing is very complex. It's under attack in Congress. It's very hard to sustain. And I think that we also see tremendous lobbying pressure on the fine details of regulation. And a lot of that lobbying pressure is around cross-border exposures. It's around trying to say, I don't have to operate under U.S. rules when I'm in another country. And as we've seen, foreign exposures have become more and more important to U.S. banks. So thanks. And we'll go on to Simon.
Thanks very much, Marcus. Nice presentation. I think I agree with everything you're saying there. I think what I'm about to say is really reinforcing that. We just had these very interesting remarks from the panel of regulators, and I think I agree that Dodd-Frank did change many dimensions of our financial system, and many of those changes were absolutely in the right direction, exactly as Marcus has said. But, you know, the very real question before us at the moment is how much change have we actually experienced, and how much more do we need to do? If we look at my first slide, oh, I got the clicker here. All right. Yeah, well. So one way to tell the positive story, to mesh also with what Marcus is saying, is to look at bank size. And this is the size of the largest 6 bank holding companies. You can do it on an easily comparable basis since 1995, including all their mergers and acquisitions. And what you can say when you look at this picture as well, here's the dramatic growth that Marcus talked about in the constant, and Senator Brown talked about this at the beginning as well. Here's the increase in concentration and the concentration of risks. And you can see the build-up from the 2000s. And then at least it hasn't got worse. And some large financial institutions like Citigroup, for example, have absolutely been squeezed since the crisis. Partly that's about the way the crisis was handled, partly it's about Dodd-Frank. These things are mutually reinforcing. And I think this was broadly consistent with the message we heard, for example, just now from the Federal Reserve. But and so this would be the largest 6 bank holding companies, now just below 60% of US GDP, consolidated assets relative to GDP. But here's another number that we should think about. And this is a number that we only have started to get recently, and it's due to Dodd-Frank, that the bank holding companies over $50 billion now have to provide a systemic risk report, which the Fed publishes. And this shows not just total assets, but also your total exposures. So in other words, how much exposure do you have through credit cards, through other forms of lending, and of course through derivatives. Now, and we might worry to some degree about whether these risks are fully measured or accurately measured, and that's part of Marcus's point that you only see the damage when the downturn occurs. But you see that at the very least, the systemic footprint of the largest bank holding companies is considerably bigger on a total exposures basis than it is on a consolidated assets basis. Now, we don't have the same data on time series, at least not yet. But we do know where the big 3, for example, came from. You can go back to the early 1980s on that. The largest 3 banks in 1983 in the US were Citigroup, Bank of America, and Chase Manhattan. They had combined assets relative to GDP of just under 10%. Now their combined assets is 27% of GDP. And if you take their total exposures, which back in the 80s, because derivatives were so small, would have been about the same size as their total assets, so that's 10%. Now they're 38%. Total exposures relative to GDP. This is a big increase. This is a big systemic footprint, and it hasn't gotten significantly smaller. At the very least, I would say that comes out of Dodd-Frank. Now, the regulators tell you, and they just did tell you, they emphasize from different dimensions, that what matters in this situation is capital, that we should make all our financial institutions safer. And they emphasize that we have more capital. They always say more capital. They very seldom in any official speech or remarks, I'm sure you've noticed this, very seldom mention the numbers. How much capital did they used to have? How much capital do they have now? And of course, there are various measures of capital. We can do it on a risk-weighted basis, and the gentleman from the Fed mentioned that. And you know, the risk weights are always complicated, they're always difficult, and they always go wrong in the crisis, proved to be wrong. I like the capital measures put out by Tom Hernig, who's the vice chair of the FDIC. FDIC, unfortunately, couldn't be with us today. Tom does these privately. It's not FDIC official numbers. They're on his website. They make for some of the most fascinating reading of any table of dry numbers you can imagine. And looking at the leverage ratio. So take out the risk-weighted calculation, just look at a leverage ratio, and convert all US GAAP accounts to IFRS, International Financial Reporting Standards, because that's the right way to deal with derivative risk. And that actually, the Tom Hernig calculation almost exactly lines up with what we see now from the systemic risk reports published by the Fed. How much capital do our largest bank holding companies have? Well, they have, on a leverage basis, just under 5% equity, 95% debt. Is that a lot of capital? So you have 5% as a buffer against losses, facing all the risks in today's world, all the risks you're going to see going through the cycle. Seems right, but rather a little to me. Do they have significantly more capital? Have they simplified themselves? Have they completed some sort of structural change that makes them more resolvable? I'm sure you have all read, just as I have, the latest living wills put out by the banks. The living wills, this is just the public portion, right? Not the really exciting stuff. This is the Goldman Sachs one. You can see it jammed to my printer. I think that's a metaphor. And so Goldman Sachs tells you, I mean, I think it's where these living wills are completely unconvincing from the point of view of can they fail without recourse to public funds, without doing systemic damage. But here's the interesting thing. On page 4 of Goldman's report, they say, well, look, we're much smaller than we were. We used to be 1.1 trillion. Now we're 856 billion. Actually, that's exactly the size they were in 2006. So they're smaller than they were in 2007, but not 2006. They say we're less leveraged. They say we used to have 26 times leverage. They claim that by that calculation, they only have 10 times leverage. In the Hernig calculation, they have 25 times leverage. They have 4% equity. So where are we on this? Where the banks are the same. The biggest banks are the same size. They've not gotten smaller. Do they have more capital? Yeah, they have more capital than they did at the height of the crisis. That's why it was a crisis. Do they have more capital than they had over the previous cycle, calculated on a leverage basis, ignoring nonsense about risk weights? I don't think so. Have they become simpler, less complex, less intensely cross-border, easier to resolve in any way? Not that I can see. So we have made progress with Dodd-Frank on many dimensions. But in terms of dealing with the large bank holding companies, the core of the too big to fail problem, there's a lot of work still to do.
Thank you. I'm Ed Merzwinski with US PIRG, and Marcus asked me to talk about non-housing markets and where we are today. Well, first of all, I think it's useful to look back at where we were yesterday, and don't forget that in addition to the mortgage crisis that we had a growth of very unfair financial practices throughout the 2000s. We had the credit card marketplace, where first they dinged people who had been late before by raising their rates. Then they said, let's ding everybody else. Let's figure out a way to have everybody pay higher rates. Triple your interest rate if you're 1 minute late. Make your bill due on Sunday. And then when it comes on Monday, it's late. And tripling your interest rate, 36%, means your monthly payment is 3% at the minimum payment that they ask for. But the average payment that they ask for is your monthly increase in the amount you owe is 3%, but the minimum payment they ask for is 2%. So you're losing ground. You're not even running in place. That's the credit card marketplace. Then you've got the auto finance marketplace, which was full of corruption. You've got banks, regulated banks, being encouraged by consultants to not bounce people's checks, allow them to overdraft automatically, but then say, oh, I'm sorry, we've got to charge you $36 for the privilege of overdrafting. So they encourage you to overdraft. It used to be they gave you a penalty, like a parking ticket, like a speeding ticket, and they said, we're going to bounce your check don't do it again. But they changed the rules and things were bad. So all of these markets were in a terrible mess. Even the regulators were forced to act on bank overdraft fees. They said that you couldn't have standard overdraft protection, which is the really bad. Standard means bad to the banks. You couldn't have standard overdraft protection unless you opted in. Saved consumers billions of dollars. And then Congress passed the Credit Card Act. Under a less enlightened OCC, that agency actually opposed improving credit card rules, but today, everybody agrees that the Credit Card Act of 2009 has really worked. It's gotten rid of gotcha fees. Consumers who have credit cards are much better off. Credit is still available, and it is available at fair prices. It's much more difficult for a bank to raise your interest rates to penalty rates. You have to be really, really bad at making payments. And then they have a roadmap built into the rules so that you can get back on the straight and narrow. And then, of course, that leads me to who's enforcing all these laws. Well, before, you had a race to the bottom with 4 federal bank regulators competing for more banks to be under their charter. The less they regulated, the more banks joined. Their castles on the Potomac grew in size, and that's power to a regulator. It was a race to the bottom. It was a debacle. And from the non-banks, the payday lenders, the debt collectors, the auto title pawn lenders, what's worse than a payday lender who takes your next paycheck? It's a guy who takes your car for an unpaid small loan. Those guys were regulated primarily by the Federal Trade Commission, an agency that had no, I love the Federal Trade Commission. I think they do tremendous work for consumers, but they had no powers to go after companies. They had no power to look under the hood. What Zixta Martinez explained earlier in her remarks, the CFPB can examine on a daily basis any aspect of a bank over $10 billion and what it does. They can look under the hood, look inside the black box. They can also do that for a number of non-banks of any size. That includes mortgage lenders, that includes student lenders, and that includes payday lenders of any size. And so you've got one regulator, there's no competition for the worst regulator, and you've got a system where things are better. I use the credit card market as an exemplar because I don't have time to go through all the markets, but I want to point out that there are some things the Card Act didn't do, but the CFPB is enforcing. So some of you may have noticed money back in your checking accounts over the last 3 or 4 years. The CFPB has recovered over $1.5 billion just from 5 big banks that were tricking people into signing up for useless add-on products sold by third-party vendors. And so the situation is there. You got your money back. You didn't have to wait. You didn't have to. You ever get these cards in the mail about a class action? You're eligible for $9 if you fill this in and prove that you spent money at this record store or whatever. They don't have record stores anymore. Sorry, at this other store. But you don't have to do that. The CFPB just gives you your money back. So I think that consumers are better off in all financial markets. I think the CFPB is also looking into new emerging financial markets, in addition to regulating the existing ones. It's fighting very hard to regulate the payday lending market and the other high-cost lenders. The emerging markets, it's looking into prepaid cards. They were never regulated. Mobile payment systems. There are all kinds of new payment systems. Very dynamic marketplace, very innovative. The CFPB is being very careful about the way it goes forward. They just issued faster payment mechanism principles. In addition, they want banks to deposit your money more quickly, give you access to your money more quickly, but they want to do it safely. I also want to mention that they also work on the what Director Cordray of the CFPB calls dead-end markets. You can pick your bank or your credit union or even your payday lender. You can't pick your credit bureau or your debt collector. It's like you can pick your friends, but you can't pick your relatives. It's the same sort of thing. And so those are dead-end markets where a consumer has no choice but to put up with a bad debt collector and a bad credit bureau. And the CFPB's been done some very interesting work in cleaning up the credit bureaus, giving us access to free credit scores, telling them that, oh, by the way, since 1996, you were supposed to send a consumer's full file to the creditor who's investigating her complaint. Gee, why didn't we think of that? The internet, email, attachments, they didn't want to do it, so they ignored it because the FTC didn't have the tools to come after them, but they're afraid of the CFPB. So all markets are getting better, good markets and dead-end markets. And also, in the time I have left, I want to mention two things. First, we have been one of the groups, this report just came out today, that has been studying the CFPB's Consumer Complaint Database. It's an amazing resource. Consumers can look at the database, they can find out what other consumers are having trouble with, what banks they're having trouble with. Researchers can download the entire database. It's got 627,000 complaints, almost 500,000 of them are public, on the public part of the database. And as of June 25th, the CFPB, as Zixta said, is now publishing narratives. So our first 6 reports, this is the 6th one on mortgage. We've done credit bureaus, credit cards, student loans, bank complaints, and debt collection complaints. Our 7th report, well, I haven't figured out what we'll do it on. We're going to have stories. We're going to be able to compare how many consumers complained for a month, how many consumers complained for a year, how many times did they complain, how many people did they talk with, how outraged were they. We'll use text software to analyze all of that. This is a very powerful tool to make markets work better, and I think markets are working better. My last comment, because I'm running out of time, is unrelated. Because the banks brought up cyber, because the bank regulators brought up cyber, I want to point out that the cyber problems that we're seeing in this country are very real and very dangerous, but they're not just dangerous to the financial system, they're dangerous to everybody in this room as individual consumers. The OPM breach addressed some 21 million applicants and their spouses and their friends and neighbors who were their references, got information about them that can be used not just to commit financial identity theft, but also medical identity theft, also harm you through emotional stress and other sorts of harms. These security clearance data that was taken includes: did you have an alcohol problem? Did you have a marital affair? Did you have any kind of run-ins with the law? Somebody could blackmail you with that information, or at least you would be embarrassed, or you could face physical harm. So I encourage anybody here that works on the Hill not to support pretty much any data breach notice bill that's before Congress right now. Talk to me first, because all of these bills specify a very narrow form of harm that is allowed to have consumer protection and preempts anything better in the states. Thank you.
Well, good afternoon, everybody. I get the pleasure of talking to you about my favorite subject, which is the housing market. And so the question, I guess, before us is what has changed in housing in the past 5 years? And I thought that I would answer that question in 3 different ways, right? So first, I want to say what has changed in the housing market in the past 5 years because of Dodd-Frank. And then I want to talk about what's changed in the housing market in the past 5 years that has nothing to do with Dodd-Frank, right? And then last of all, I'd like to talk about what hasn't changed in the past 5 years. And I think that those 3 questions all put together give a great explanation of where the housing market is today. So the regulators actually pointed out a lot of the points that I would make about what Dodd-Frank has changed. Obviously, the ability to repay requirement rule has been incredibly impactful in changing the kind of quality of mortgage products that exist in the United States or made available to consumers. Before the financial crisis, the most popular subprime mortgage product was something called a 228. That is, it had a 2-year kind of teaser interest rate, and then after that, it adjusted. Well, a lot of people got in trouble with this. Another really popular product was a stated income. When you look at the markets today, the subprime markets in particular, you don't see those type of products being offered to consumers. They are virtually non-existent, and that is a good thing. because it allows people to be in sustainable mortgage products, and it makes sustainable mortgage products more at the focus of not just the conventional market, but also the subprime market. Kind of a corollary to that and that sustainability is the fact that we have a qualified mortgage definition that sets out what responsible lending can in many ways look like. And so conditioned with that, we have, a standard that endorses a 30-year fixed rate mortgage in very important ways. And for the average American consumer, they don't really do that great with actually dealing with the adjustable interest rates, right, after a certain period of time. And so this traditional kind of 30-year fixed rate mortgage is desirable in many ways. Kind of along with that is the most important thing, and a lot of people have touched on it, but it can't be overstated. Before Dodd-Frank, we did not have federal regulation in the mortgage space of non-depository lenders, right? And so what was happening is that you had a lot of non-depository mortgage lenders who were being regulated on a state level who were engaging in a lot of egregious behavior. And because they were not subjected to the same oversight that existed through federal regulators, and we can even question the quality of that oversight given what happened in the financial markets and the housing market in particular, but because they were not subjected to the same standards, it created this incentive to actually, I guess that's how you get to a race to the bottom, right? You have non-regulated entities that are engaging in more egregious behavior, which encourages regulated entities to try and figure out how they can do the same thing so that they can make just as much money. Dodd-Frank put an end to that by allowing the CFPB to have the authority to regulate both depository and non-depository institutions in their mortgage origination practices and their servicing practices. And that has made a significant difference and impact in ensuring that the market is a quality market for all consumers. The last thing that I think Dodd-Frank changed is talking about it on the other side, which is obviously we are all talking about mortgages and we want them to be safe, but we also have to look at them from the perspective of what happens after they are originated and then sold, right? So the qualified residential mortgage definition and how we regulate mortgage-backed securities has also been an important component. One of the most significant things about that is not just the QRM rule, but ultimately where regulators ended up with respect to that rule. There was an effort at one point and a suggestion, I guess this is where the regulators are referring to the fact that they got 400 members of Congress to tell them that they were wrong. There was an effort to require 20% down as what we would identify as a quote-unquote safe, I'm good on my time? Yeah, safe mortgage. We don't have that requirement because of the effective advocacy of the people in this room. The one thing I want to point out that is changing outside of Dodd-Frank, which I think we should also pay attention to, is that as a result of the poor quality of the mortgages that were initiated before leading up to the financial crisis, we have a strong focus by regulators on enhanced quality control and oversight and enforcement. Right? FHA, the Federal Housing Finance Agency, received a lot of mortgages that had deficient aspects to them. And as a result of that, they've been very adamant in looking through their portfolios and requiring lenders to actually remedy their defects. So one of the things we have to pay attention to is the consequences that has and the relationship it has to access to credit, even though it's the smartest thing that regulators could have done and should have been doing all along. The last thing I just want to point out is what has not changed. Well, the fascinating thing about all of this is that even though it's been 5 years and Dodd-Frank is passed, what hasn't changed is that Fannie Mae and Freddie Mac are still under conservatorship, right? So the conservatorship itself of the two largest guarantors and securitizers in the United States for mortgage products is still ongoing. And I leave that as the final point only to say that when we look at the whole housing finance system, we will at some point have to address that issue. And even though Dodd-Frank doesn't do it, subsequent legislation or regulatory practices will ultimately have to. Thanks.
My name's Jerry Epstein, and first of all, I want to thank... No, it's okay, we'll forget about it. I thought I had a PowerPoint, but it's not, so that'll save you some slides. My name's Jerry Epstein, and I'm very pleased to be here. And I want to commend the Americans for Financial Reform for all the important work they've done. I was asked to talk about things from a somewhat more macro perspective. And so let me first start off by giving one clear indicator as to how we know the financial intermediation system is still broken. We know that monetary policy, QEs 1, 2, and 3, has not had a huge impact on getting the economy going again. And there are a lot of reasons for that, but one of the reasons is that the financial intermediation system is still broken. It hasn't really recovered from the crisis. I had a slide showing you massive increases in excess reserves being held on the balance sheets of our banks rather than being lent for small businesses, investment, and so forth. So we still have a dysfunctional financial system in a lot of ways. And what I want to do is kind of step back and say, well, what is the financial system supposed to do for our economy? And how well is the financial system performing these activities? Now, this is a point that Americans for Financial Reform has had at the forefront for many years now in the work that they've been doing. They've been concerned with financial stability as one issue, but a related issue is the roles that finance is supposed to play in serving Main Street, in serving households, in serving the real economy. So I'm going to talk about 6 roles that finance should play in an economy. I got these out of a textbook that I use to teach my money and banking students, and probably some of you had this kind of a story in the money and banking courses that you've taken over the years, some more recently than others. The first role is channel finance to productive investment. And if one looks at a graph of what banks have been doing over the last 20 years or so, and certainly after the so-called hypercharged period that Marcus talked about, what we see is the amount that's been lent for commercial and industrial loans has been going down, 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 and the amount that's been invested in hypercharged investments has been going up, 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 including, first of all, the real estate, and now in other kinds of financial assets. So in terms of channeling resources for productive investment, our financial system is still not doing a very good job. What's it doing instead? Well, a lot of finance is lending to each other. The amount of intra-financial lending, one bank to another bank, went up dramatically before the crisis and has not come down. It's still very high. And what is this for? A lot of this is for the so-called shadow banking system that our colleague from the Federal Reserve mentioned, to allow banks to extend the intermediation chain, have more counterparty connections, derivatives, as Marcus was talking about, spanning the globe, and not ultimately investing in for the real sector, but often for financial investments. A second role is provide mechanisms for a household to save for retirement. A big problem that we have, and we still have to solve this problem, is the amount of excess returns that those who manage our retirement savings get. I had a graph to show you from John Bogle, the Vanguard guy, showing that if you put in, what did it show? If you put in $20,000 over 30 years, the amount that you're going to get if you put it in an index fund relative to a managed savings fund is almost double. Why? Because the managed fund, active trading, they take out a lot of fees and costs, and the household doesn't get it. So that's one way in which the financial system is still not serving our needs very well. A third role from the textbook that I use is the financial system is supposed to reduce risk. Well, we know from the financial crisis that it didn't do a very good job of that. But as we heard this morning and this afternoon, the Dodd-Frank has been trying to reduce risk in the financial system. As Simon said, it's had some successes, but still a lot of the risks are still there. The fourth and the fifth functions of the financial system are to provide stable and flexible liquidity and to provide an efficient payments mechanism. Well, in terms of liquidity, what we saw in the run-up to the financial crisis, the housing bubble, that too much liquidity got into the system on the run-up, and then when the financial bubble collapsed, liquidity disappeared. It evaporated. So there's, as Marcus said, there's a big debate over, well, is Dodd-Frank reducing liquidity to the system? The banks that provide liquidity do not provide liquidity as a public good. They provide liquidity to make money. And the way our system has been operating is they provide liquidity, a lot of liquidity, too much liquidity when there's a bubble up, and they take away too much liquidity when there's a downturn. And the liquidity requirements that, that are part of Dodd-Frank may help that some, but as Marcus showed, we still have problems with this. Finally, useful financial innovations. Well, Paul Volcker, who you all know, used to be a big friend of bankers when he was head of the Federal Reserve and raised interest rates. They liked that a lot. But recently, he hasn't been so well liked by the bankers because, among other things, he said that the only really useful financial innovation that has taken place in the last 20 years has been the ATM machine. Whether that's an overstatement, I'm not sure, but a colleague and I did a study of financial innovations, and we showed that at least 40%, if not more, are primarily used for regulatory and tax evasion rather than to increase efficiency and increase the size of the economic pie. And we don't have any indication that financial innovations have improved since Dodd-Frank. The key problem is that as long as it's lucrative for the financial sector to engage in activities that don't help Main Street, they're going to continue to do that. That's how they're going to get their bonuses, that's how they're going to get their profits, that's how they're going to get their returns. What Dodd-Frank has done is reduce the profitability of some of these activities. And that's a very good thing, because that means that in some respects, the bankers are going to spend more of their time investing in Main Street and not on Wall Street. However, as the Federal Reserve person said, and as Marcus pointed out, these risks are migrating to shadow banking, to asset management, because they're lucrative. And as long as those remain very lucrative, the amount of time and energy and funds that are going to Main Street are going to continue to not be enough. And these functions that I pointed out are going to continue not to be well served. So while Dodd-Frank has helped a lot, we still have a lot of work to do. Thank you very much.
Okay, thanks to everybody, and we have about 10 minutes until Elizabeth Warren's speech, but I think we'll open the floor up to questions at this point, if people have questions for our panelists. Okay, well, not seeing hands, I'll take the moderator's privilege and ask the first question. To Simon and Jerry, one thing that has not come up at all in this discussion, but is actually, or in the regulators panel, surprisingly, but actually is reaching a milestone next week, is the Volcker Rule, which was, of course, one of the most prominent elements of Dodd-Frank, and the proprietary trading half of the Volcker Rule, the part where banks are actually supposed to not trade for their own account, but only service the markets through market making and underwriting and so forth. That is due to begin being enforced actually next week. So I wonder, I know that both of you, Simon and Jerry, have followed the Volcker Rule since the beginning. I wonder if either of you have any thoughts about how far we've come with Volcker, whether the regulators are going to go far enough in terms of restricting banks from doing market gaming that is not necessarily beneficial and is for their own benefit and not not a genuine service to the market, and what we should be looking for over the next year or two in terms of whether the Volcker Rule is being implemented properly and being implemented well.
So I think the Volcker Rule, well, as you know very well, was a compromise. It was what could be achieved, and it was trying to get at and limit the ability of banks, particularly the largest banks, to take bets on their own account rather than to trade for customers. And I think it will have some effect. Precisely how much it affects, we'll see, potentially an effect on the volatility of banks' profits. If it was the case in the past that they could make a lot of money using this kind of trading in some quarters, and they could lose a lot of money. So that's one place that you'll see it. You're asking, obviously, the right and the most difficult question, which is, will the regulators follow through? How will it be enforced? What's the position, for example, the New York Fed going to be in terms of whether this or that is actually proprietary trading? We probably shouldn't get too optimistic about the extent of those changes. There is an interesting debate now, which has been mentioned, about market liquidity. And I think there are some greatly exaggerated claims that the Volcker Rule and other changes related to Dodd-Frank and capital requirements have impacted market liquidity. And I think that's a discussion worth having. I think the arguments being made by the industry are almost completely wrong. There's a House hearing coming out on this, I think, as soon as next week. So it's an important discussion. It's important for people to be engaged with that. I think the Volcker Rule will end up having a minor effect on the margins.
Just briefly. Technology is failing me today. Just to add to that, I think it's important to understand that the Volcker Rule is part of a more global set of policies that have been put forth in similar policies in the United Kingdom. There's the Vickers Rule in Europe. There's the Lindbergh Rule, all designed to ring fence, to separate out highly risky activities by banks that also are very involved in the payments system and get a lot of protection from the government. So the idea behind the Volcker Rule and these other rules, I think, is very important. And but as Simon said, and is well known, these were very weakened. The Volcker Rule was very much weakened by activities, by lobbying by the banks. So I do think it's important to look at ideas to do this ring fencing and separation, and perhaps the new Glass-Steagall rule that Senator Warren may be talking about is an important place to look.
I think I would add to that, since the Volcker Rule is something that AFR has been working on for a long time, that we really don't, it's really very unclear how we're going to have the transparency to see what difference the Volcker Rule is making, beyond just looking at the 10Ks of the major banks to see their trading revenues, exactly how it's being implemented. I think that we have to ask the regulators to be a little clearer and more forthright about exactly what they're doing to implement the rule. Otherwise, we may just not really know if it's working. So Mitri, I had a question for you, which is that especially post-financial crisis, I mean, we've seen in Dodd-Frank, as you pointed out, an effort to really improve the quality of credit and prevent people from getting mortgages that they couldn't pay back, or mortgages that were inappropriate for them. At the same time, people have raised concerns about access to credit, particularly in minority communities. I wonder if you could just talk about how to strike that balance properly and what people are doing to address that.
Yeah, I mean, one of the challenges is that a lot of people are making the argument, particularly in the housing sector, that regulation is in some way restricting access to credit. Once you look at the data, it really doesn't support that assertion. One of the easiest ways to look at that is actually to look at smaller financial institutions, community banks, which we define as institutions with less than $1 billion in assets. What you see is that in the aftermath of the implementation of the qualified mortgage rule, they they actually are generating quite impressive profits. In fact, they're more profitable than their larger financial institution counterparts. And that is to say, the reason why you want to look at that for kind of regulatory challenges is the notion behind it is that smaller financial institutions have smaller staffs. Therefore, regulatory requirements actually impose a greater burden on them in terms of having to beef up personnel with respect to hours. So if the costs aren't really there on a smaller financial institution basis, it's hard to believe that Bank of America or Wells Fargo is somehow impeded from going into the market and giving people mortgages because of the changes in regulations.
Okay, thank you. I see one question from the audience here. Yeah. Well, we heard from the OCC that is a priority for the regulators, and he also singled it out as, I think, a critical priority. And we view it, and I view it as probably the most important outstanding rule from Dodd-Frank that has not been implemented. But regulators have made a commitment to implement it, to at least, to repropose it, to move forward with that rule, and we're waiting on it, I think. So it's really a critical question. So I've seen several of Senator Warren's staffers enter. I believe that she will be here shortly. Is that right? Okay. Yeah. Okay, so are there more questions from the audience, or? Okay, I'm on the spot at this point, I think. Yeah. Anything to add?
Here's a question.
Oh, actual question? Sure.
So before Dodd-Frank, the regulators actually had a lot of tools, but they chose not to use them. People like Alan Greenspan, ideology got in the way. So Dodd-Frank went far to avoid that. I've heard Dr. Johnson use the bright line. Mark, do you think Dodd-Frank is stringent enough to avoid that scenario if a Republican comes to election and they usher in their people? Do you think that ideology can get in the way of enforcing this?
I think a fundamental thing about Dodd-Frank is it gives tremendous discretion to the regulators. So there are a lot of instructions to regulators in Dodd-Frank, but they also have a lot of wiggle room in terms of how they implement those directions. So I think appointments, the people who are appointed to run the regulatory agencies, is critical. Oversight is critical, and I think given that level of discretion, I think we're always going to be in this situation where we have to be vigilant that regulators don't drop the ball again.
I would say absolutely. If the next president wants to roll back Dodd-Frank, and if that president has sufficient support on Capitol Hill, partly will be through appointments, partly there are some things that they would need to repeal. The whole thing could be gone in 2 years.
All right, continuing seamless transitions. Give people 1 second to, yeah. Tag team speaking, yes. We're not giving people any break. There is coffee and tea in the back, but people aren't allowed to take it. So it's a very great pleasure to introduce the next tag teamer, Senator Warren, to close the program. In addition to being the intellectual author of the CFPB, you may not know that Senator Warren was also absolutely central to bringing together our coalition, which has fought for it. So it is especially excellent to get to mark the 5th anniversary of its signing, the signing of the law with her. It's also really hard to imagine where we would be on all of these issues. Simon closed by talking about how easy it would be to make it all go away through any number of paths, but the resonance of the the resonance of the analysis that Senator Warren presents so powerfully, both about the injustices of rules rigged to favor Wall Street and about the possibility of changing those rules, really has transformed the public debate and prevents these incredibly important policy decisions from slipping back into the kind of obscurity and the one-sided industry control that comes with it. And without that, I don't think we would stand a chance without the visibility she creates for them. And with it, I think we do. So, Senator Warren, it's a great pleasure.
Thank you. It is good to be here with AFR. I am delighted, and I appreciate the introduction, Lisa. I look out and I see so many good friends who've worked so hard on a huge number of issues. We all have the scars to prove it, but we also have the victories to prove it. You know, I am delighted to be here on the 5th anniversary of the Dodd-Frank Act, celebrating with Americans for Financial Reform. Without AFR and the incredible work of many people in this room and many people across the country, there would be no Dodd-Frank to celebrate. And our country would be lurching from one financial crisis to another. So I just want to start by saying thank you for all that you have done in this. Thank you. That's why we're here. Now, I'm here today to say 2 cheers for Dodd-Frank. 2. It would be 3, but there is still a lot of work to be done. You know, for me, the context of evaluating Dodd-Frank is how our government responded after the last major financial crisis, the Wall Street crash of 1929. After the 1929 crash, policymakers took strong action to fundamentally change the structure of our financial system so that Wall Street couldn't push the economy over a cliff again. The new rules were creative and unprecedented. First, a cop for Wall Street, just like there are cops for Main Street. The new agency, the SEC, was charged with enforcing the basic rules of the market. Second, make it safe to put money in banks. FDIC insurance created security for families and stability for the banking system. And third, banking should be boring. Glass-Steagall built a wall so that banks could not use government-guaranteed deposits for high-risk speculation. And for half a century, those 3 rules worked. There wasn't a single serious financial crisis, and the financial sector did its part to produce sustained, broad-based economic growth that benefited millions of people across this country. It worked. And then, in the 1980s, Congress and our regulators started unwinding those time-tested rules. The Fed and other bank regulators looked the other way as big financial institutions invented new ways to trick their customers, first with credit cards and then with mortgages, home equity lines of credit, and many other financial products. Second, Washington turned a blind eye as risks were packaged and repackaged, magnified, and then sold to unsuspecting pension funds, municipal governments, and many others. And third, that high wall between high-risk trading and boring banking was punched full of holes until in the late 1990s it was knocked down when Glass-Steagall was eventually repealed. And not long after that, the worst crash since the 1930s hit the American economy, a crash that the Dallas Fed has estimated has cost this country a collective $14 trillion. Now, for me, the moral of this story is pretty simple. without basic government regulation, financial markets don't work. That's just an empirical fact, clearly observable in 1929 and again in 2008. And the point is worth repeating and repeating again, because for too long, the conventional wisdom has been you can be for rules or you can be for markets, but you can't be for both. And that is just plain wrong. Rules are not the enemy of markets. Rules are a necessary ingredient for healthy markets, for markets that create competition and innovation. Rolling back the rules or firing the cops can be profoundly anti-market. We need rules. But of course, not all rules promote innovation and competition. So what tests should we use to determine that the rules we're looking at promote healthy competition and innovation? Well, I want to start with two basic principles that were there for more than 50 years after the 1929 crash. First principle, financial institutions shouldn't be allowed to cheat people. I know that was controversial in some places, but it's really worth looking at. Markets work only if people can understand the products they are buying, only if people can reasonably compare one product to another, only if people can't get fooled into taking on far more risk than they realize, or that's just so that some corporation can turn a quick profit and move on. That is true whether we're talking about families buying mortgages or whether we're talking about pension plans buying complex financial instruments. So, first, financial institutions shouldn't be allowed to cheat people. And second, financial institutions shouldn't be allowed to get the taxpayers to pick up their risks. That's true for insured deposits, for high-risk trading, and that is the reason we had Glass-Steagall, to make sure that that didn't happen. And it's true for letting too big to fail banks get a wink and a nod government-guaranteed bailout. Now, judged against these two principles, Dodd-Frank made real progress. Look at the first goal, no more cheating people. Dodd-Frank took a powerful step toward honest markets with the establishment of the Consumer Financial Protection Bureau. Yay! Instead of, think about it, what the world looked like before we had the CFPB. You kind of had this grab bag of consumer protection laws scattered among 7 different agencies, none of whom had any real interest in enforcing the law. And Congress instead created a new agency that had the tools, the expertise, and the responsibility for making sure that consumer financial markets work fairly. This was structural change, and it is working. Mortgages have gotten clearer and easier to read. The agency is fighting back against big banks that have cheated consumers. In fact, I'm sure you've been talking about it today. The agency has just announced that it has returned more than $10 billion directly to consumers who were cheated, and that's in just 4 years. Can we have a round of applause? That's government that works for people. I love this. And on the second goal, making sure that financial institutions can't push their risks off to the taxpayers, Dodd-Frank made important contributions here as well. It helped bring back some level of market discipline through living wills and through the creation of the Orderly Liquidation Authority, and it reduced system-wide risk by imposing more demanding capital and leverage standards. Dodd-Frank built a foundation for safer financial markets, and it's worth celebrating. 2 long, loud cheers. More importantly, it is worth defending from those who would like to weaken our financial markets just to be able to rake in more profits. But there is a lot more work to be done to complete the unfinished business of financial reform. In the past few weeks, I've discussed several steps that Congress and our regulators could take to help complete that work. These steps should appeal to anyone, Democrat, Republican, Independent, libertarian, vegetarian, the whole group. Anyone who wants safer, more competitive financial markets. And in fact, in the past 2 months, I've introduced 3 bipartisan bills that would help us move in that direction. So there's a lot I could talk about, but I know I'm the last one for the day. So I'm just going to hold this to talking about the 3 bills that I've introduced recently, these 3 pending pieces of legislation, pieces that could help us complete the work that Dodd-Frank began. In May, I introduced the Truth in Settlements Act with Senator Lankford. Now, right now, our federal agencies never take any big bank to trial. Instead, over and over and over again, they end up entering into settlements and then, all too often, hiding the critical details of these settlements from the public. Agencies want those big headlines. They like to trumpet that they recovered billions of dollars from big banks. But if you dig a little deeper, you find that the payments are tax deductible, or they aren't payments at all. They're just credits for things that the banks were going to do anyway. You know, you add it all up, and a lot of times that big headline number is a lot lower in reality on the ground. So our bill would shed more light on the government settlements by requiring the government to disclose all the relevant details and post copies on the settlements online where anyone can read them, where researchers can analyze the deals that have been made. This bill would allow the public to hold our federal agencies accountable if they cut bad deals, deals that are good for banks but bad for everyone else. Good move in the right direction. Now, in May, I also introduced the Bailout Prevention Act with Senator Vitter. In the 2008 crisis, the Fed used its emergency lending authority to provide, I'm glad you're all sitting down, $13 trillion in low-cost loans to just a handful of too-big-to-fail banks. I want you to think about that. It wasn't TARP. It wasn't anything Congress voted on. This was just the Fed quietly moving money over to the biggest financial institutions in this country at basically zero cost. On their own, the Fed was shoveling money in to the too-big-to-fail banks. So the bill that we've proposed carefully limits the Fed's ability to provide emergency lending to a giant bank that gets into trouble. It makes clear that the Fed is not the personal piggy bank for the biggest financial institutions, and it forces those banks to bear the consequences of their own risk-taking. Third one, just last week, I reintroduced the 21st Century Glass-Steagall Act with Senators McCain, King, and Cantwell. Our bill would rebuild the wall between commercial and investment banking, the wall that produced a healthy financial system and sustained economic growth for half a century. You know, the idea is pretty simple behind this one. If banks want to engage in high-risk trading, they can go for it. But they can't get access to insured deposits and put the taxpayers on the hook for that risk. Now, these bills aren't the law yet, but they demonstrate that it's possible to make bipartisan progress to complete the unfinished business of financial reform. I just want to underline, I have a Republican co-sponsor on each one of them, and we're going to fight to turn these bills into law. Now, oh good, I'll do that. Yes. Yeah. Good to get the applause line in because we all know that the big banks are fighting tooth and nail against these changes. And we saw them flex their power last December when they blew a hole in Dodd-Frank as part of the Cromnibus. So this isn't going to be easy. The way I see it, we can either give up or we can fight back. Me, I'm fighting back. Before I finish, I want to touch on the latest attempt to roll back some of our critical financial rules. You know, in Dodd-Frank, Congress directed the Fed to impose tougher standards on the banks with more than $50 billion in total assets. Now, that covers about 40 of the biggest banks in our country. Do the math. That's a little over 0.5% of the 6,500 banks in the U.S. These tougher standards are commensurate with the rules intended to make sure that the biggest banks can't threaten our financial security. Things like higher capital and leverage ratios and stricter management requirements. Of course, even among the group of 40, some banks pose more risks than others. And Congress acknowledged this fact, and it directed the Fed to tailor its tougher rules to match the risk that an institution poses, asking it to look at things like size, complexity, and type of financial activities that a bank engages in. So there'd be some readjustment even within the 40. However, these bigger banks and their allies in Congress are now pressing to increase the $50 billion threshold and exempt dozens of banks from these tougher standards. They want to see a much higher number. Republicans on the Banking Committee recently voted unanimously to raise the threshold all the way to $500 billion. That would exempt about 30 of the about 40 banks. And collectively, those 30 banks hold more than $4 trillion in assets. Now, keep in mind that the Republicans want to turn loose all of these banks between $50 billion and $500 billion. Those banks are the same size as the banks that played a key role in sparking the 2008 crisis. Anyone remember Countrywide? Countrywide had about $200 billion in assets when it started to falter. Anyone remember Washington Mutual? Good old WAMU? WAMU had about $300 billion in assets. And look, even though the failure of a single $50 billion bank may not be enough to cause a financial crisis, the failure of a few banks of that size, a definite possibility in a time of financial stress, would be enough to threaten our markets. As Fed Governor Dan Tarullo said last May, quote, "If a number of these banks simultaneously came under pressure or failed, a harmful contraction of credit availability in significant regions or sectors of the economy could ensue." Secretary Treasury Jack Lew said last week that raising the $50 billion threshold and exempting several of these large banks from additional scrutiny would, and I quote, "go at the heart of some of the protections we've put in place since the financial crisis." I agree. Congress should not lift this threshold. I applaud the Secretary and the administration for standing firm on this issue. And I'm going to give them a round of applause. Good for them. Good for them. So I am delighted to be here today. I appreciate having this opportunity. I am proud to stand with AFR because of the work you have already done. But I am even prouder to stand with AFR because of the work we will do together in the future. Financial reform isn't finished, and we won't end too big to fail until it is. Right now, the Republicans want to roll back Dodd-Frank, returning us to the days of bubbles and buyouts. We are here to fight back. We know the changes that we need so that financial markets don't just work for powerful insiders, but so that financial markets work for everyone. The key steps aren't complex or difficult to understand. They just take a little political courage. So I'm glad to be here among the courageous. Thank you. Good to be here today. Thank you. Thank you, Lisa. Thank you.
All right.
I thank you all very much for coming. So many of you for sticking around all day. Look forward to continuing the conversation.